Osama, thank you very much for joining us today. We are in London for the World Nuclear Symposium 2024, and there's record attendance at this year's events. Take us through the numbers.
Well, it's lovely to see you once again. Welcome back to the World Nuclear Symposium. Okay, so this year, as you said, this is the biggest ever World Nuclear Symposium. We had 800 people registered, and this is because we had to cut it. We couldn't really fit any more people, so that there could have been more people here had the venue been bigger. So I think it's very exciting, and I think that you've seen today the lively conversations, the very interesting speakers. So I think this is very excellent.
And where is the additional demand coming from? Why is there so much more interest this year versus last year?
You know, I think it's many things. I mean, I think we all agree that nuclear energy in general has become a much more well-known and is more in the forefront of many minds. So it's normal that there is interest. So both from the industry, so there is many more people coming from the nuclear industry today here to actually, share, network, share best practices. But I think that the other thing that is very important is there are many people from outside of the nuclear industry that actually are here. We have many financiers. We have people from the intensive industries community. All those people, they are very interested in nuclear and they need to learn more. They need to see how nuclear energy can be, in some cases, help them decarbonize or how they can contribute to the nuclear adventure.
So you mentioned there was a lot of people from the finance industry, and I noticed that when I went through the participants list, a lot of people from the investment side. Some of the world's largest investment managers are here, also some very large hedge funds. Maybe you can speak to that.
Yeah. So we will have, in fact, tomorrow, we have a session specifically on finance, and you said with some of the largest investment companies, HSBC, UBS, etc. I mean, so big companies, and they are going to tell us how they see opportunities investing in nuclear. In addition to HSBC, in addition to UBS, in addition to some of these other big investment companies, we have BlackRock, one of the biggest asset managers in the world. They are here in a different role. I asked them to be a little bit disruptive, a little bit. I want them to help me shake up the nuclear industry into going to the next level to deliver the full potential of nuclear energy.
One of the mandates of the World Nuclear Association is to educate its various stakeholders. You're always putting out new research, and you recently came out with a new report titled the World Nuclear Performance Report. Take us through that report and what sort of information can someone find in it?
Yes, so the World Nuclear Performance Report 2024, what it does is summarizes the performance of the global nuclear industry through 2023. It's a backwards-looking report. And what we see in this report is an industry that is performing really, really well. So the total amount of energy that was produced by nuclear energy in 2023 grew up, additional more than 50 terawatts in 2023. So that is a great accomplishment. Another thing that grew in 2023 was the capacity factor. So the average capacity factor all over the world went up all the way to 81%, 1% above the previous year. But of course, this is the global average. You know that in many countries in the world, we have reactors operating at 90, 92, even higher. So fabulous performance. And what I think is very important is we saw that great performance is the same for brand new reactors as for reactors that have been operating for 40, 50, 60 years. So essentially what we see in this report is a healthy industry, very stable, ready to go to the next level, as I was just saying.
And if somebody would like to access that report, where can they find it?
This report is available for free in our website, as all the previous reports, so you can actually see the upward trend. So just come to the World Nuclear Association website and download it for free. And as well as many of our flagship reports are available there, most of them for free and open to everybody.
So you're always speaking at various events, promoting the messaging of the WNA. Do you have any upcoming events that you will?
It's a crazy time of the year. So we are actually, I think that one of our big priorities right now, we are ramping up towards COP29. So as you know, we launched last year the Net Zero Nuclear Initiative. So we are putting a lot of effort in bringing all this energy and all this momentum that we started last year in Dubai at COP28. So the first thing that we are doing is in a couple of weeks, September 23rd, within the context of Net Zero Nuclear, we are going to have a big high-level event. When I say high-level event, I mean heads of state, I mean ministers, I mean CEOs. And this event is trying to bring the first movers from the finance community that are going to help finance the tripling of global nuclear capacity by 2050. So you will see big names there that are already working with us, working with the governments. You know that we have 25 countries that have committed to tripling nuclear capacity. We will unveil many more in this event, and then we will unveil all these different financial institutions that are ready to help to find good ways to finance this enormous growth.
And can anyone attend that event?
So this particular event is going to be an invitation-only event, but we will make sure that it's available to everybody to see at least virtually, so you can see what is happening, what are the messages, what are the outcomes.
So 2025 is going to be a big year for the WNA. You're holding your 50th symposium. Yes. What events do you have planned?
Yes, as you said, so this is a huge, momentous occasion for us. So this is the 50th World Nuclear Symposium. So obviously, this year is already a very big event, as we discussed earlier. But what we are trying to do next year is really a step change. So we've been doing this for the last few years to not only bring the global nuclear community together, but to actually share this moment with external stakeholders, financiers, and energy users, and all other stakeholders that are interested in nuclear. So what we want to make next year is exactly that. It's a moment in time where anybody in any sector that they feel that nuclear energy could be important to them, whether they want to be a part of the journey or because they need the carbon-free, abundant, 24/7 energy, I hope they all will be there. So I think it's going to be enormous, and I look forward to having you there next year with us.
By all means, it sounds exciting. Well, I want to thank you very much for spending time with us today, and congrats to you and your team for another successful event.
Thank you very much. Thank you.
John, thank you very much for joining us today. You were in London meeting with investors. I'm curious about some of the investors you're meeting with. Maybe you can describe the nature of these investors. Are they long-only funds, hedge funds, family offices?
Yeah, great to be in London at WNA for second year in a row. I think this year is the all-time record high for attendance, and the event sold out. So lots of interest in the sector, and we've seen the same level of interest amongst institutional investors and family offices that we're meeting this week in London. But I would say it's been incredibly versatile in terms of the interest. I mean, yesterday I met with a energy transition fund. We met with some infrastructure and mining funds. We meet with family offices, and they're all kind of interested in how uranium is playing a role in broader themes related to electrification, decarbonization, and just kind of an interesting commodity play. And I think that's why it's been so appealing to so many different types of investors the last few years.
And are these existing clients that you're meeting with, or are they new investors to the space?
Yeah, we typically split our time between existing shareholders that are looking for market updates, get our latest thoughts on what's going on in the uranium market. But it's always great to meet new institutions that you're meeting for the first time. And many of them are actually very early in their uranium journey, so to speak, in terms of them trying to understand the uranium market. It is an opaque market. It is a quirky market. So we really do our best to help them understand the market fundamentals and really kind of, cut through a lot of the noise, because there has been a lot of noise in the uranium market this year.
And so when you meet with existing shareholders that know the space relatively well, I'm curious what the feedback is you're hearing from these people. Are they concerned about the performance that we've seen this year, given the positive backdrop within the uranium sector?
Yeah, I think that's a fair point. For investors that have been positioned in the sector for, I would say, anywhere from 1 to 3 years or more, it's been a head-scratcher year. A lot of them are kind of scratching their heads saying, what is really going on? We obviously had a huge move last year in the price of uranium. which was very back-end loaded, coincidentally, starting with WNA last year. It seemed to be the catalyst that took the price of uranium up from $60 to $91 at the end of December. But this year has been a lot of mixed messages, a lot of mixed signals that the market's trying to figure out what's real and what's not. I would say there's a lot of wait and see going on, waiting and seeing what the Kazakhs were going to tell us about their production, waiting to see how the U.S. political winds are shifting and how that may affect energy policy. So I think it's been a year of wait and see. I think the utilities have been, a little bit on the sidelines in terms of procuring uranium to find out what was going to happen with the sanctions against Russia, what was going to happen with the waiver process through the Department of Energy. So we have very bullish long-term fundamentals, but we have a lot of wait and see kind of news items that I think have kept people somewhat on the sidelines.
So let's look at the Sprott Physical Uranium Trust, their SPUT product. And I'm curious you're currently sitting on 65 million pounds. NAV's around $5 billion, give or take, depending on what day of the week it is. And I'm curious how many pounds you have acquired this year.
Yeah, so this year I think we purchased about 2.5 million pounds to our stockpile. We were at a premium to our net asset value at a few points earlier in the year. And we took advantage of that by issuing new units and buying more material. And that's the basic mandate of the fund, to make it larger and more liquid so that institutions can participate. And I could tell you, when I talk to institutions and they look at the fundamentals and of the sector and they say, this is a really interesting commodity with what they think is a long runway ahead of it. And then they say, okay, how do I get positioned in the sector? And often it's a pretty short conversation because these institutions are obviously trying to deploy significant amounts of capital. And when they look at the liquidity parameters and the market cap profiles of some of the companies, they quickly determine that there aren't that many things they're able to invest in because of internal, constraints and limitations. So the Sprott Physical Uranium Trust is usually a vehicle that they look at and consider. I think it's one of the reasons why it's mostly institutional investors that have positioned themselves. Obviously, there's some of the leading, larger cap companies that they're all looking at, but it's really hard for these institutions at this point in the cycle to go too far down market cap. And I think it's going to change. It is changing, obviously, as these companies recapitalize and their market values go up.
So you mentioned that this year you've acquired 2.5 million pounds year to date. Last year was 4.5 million pounds. The year prior, 2022, was 18 million pounds.
Correct.
Why is the amount this year so low compared to last year and the previous year?
Yeah, well, I think it goes back to, we had a very sharp price increase at the beginning of the year. And then we've obviously had a correction where we've gone from kind of 106 to 80. I think people are kind of questioning, why did we have such a meaningful correction when the long-term fundamentals are real, when utilities clearly need to rebook their contract PALs, and that when you look at the longer-term fundamentals, there's appears to be a 1.3 billion pound shortfall between expected primary production of uranium and expected global nuclear fuel demands to 2040. So I think people sometimes get concerned about, the long-term fundamentals, and become disconnected from short-term, noise, which I think is, we've had to deal with quite a bit of it this year.
Let's look at uranium within the context of the global economy. And Goldman Sachs recently cut their oil forecast, and they just recently cut their copper forecast quite significantly. They took it from $15,000 a ton down to $10,000 a ton for 2025. The reason why they did that is because of this pullback we're seeing in China, but we're also experiencing a slowdown in the U.S. economy, as witnessed by numerous companies when they reported their Q2 numbers. But what impact do you think this slowdown that we're seeing in the global economy is going to have on the uranium price and also the whole overall thesis?
Yeah, there's definitely been an impact to higher interest rates the last 2 years. We definitely see a correlation between the start of the central bank tightening cycle that really commenced in May of 2022. It really did have an impact on a lot of financial assets, including commodities like uranium. But bigger picture, if you kind of take a step back, uranium is incredibly economically insensitive because you really can't substitute uranium. You can't thrift it. Nuclear power stations basically have to buy it to keep their plants running. And that's one of the, I think, main appeals of uranium as an investment, is because it does behave very differently than economically sensitive commodities like oil and copper, which obviously are a little softer right now because the Chinese economy and the Chinese real estate market are struggling.
So let's talk about inventory levels now. And UxC recently came out with a report, and they stated that utilities have been letting their inventory levels draw down in the last couple of years. And when you look at the various regions throughout the world, in the U.S., they acquired approximately 2 million pounds over the last couple of years. The Europeans acquired a similar amount, but China acquired 85 million pounds. Can you speak to this?
Yeah, I mean, everybody pays very close attention to utility inventories because they're the largest buyer of uranium in the world. You know, financial intermediaries and non-utility buyers are a much smaller part of the market. So we look at this data because it's important to get a sense of where we are in the cycle. Where are we in this contracting cycle? And typically, the patterns historically are you have basically restocking cycles followed by destocking cycles. And I think it's fair to say from 2012 to 2020, we were in a destocking cycle where utilities were basically working down excess amounts of inventory. We feel as though that period is now behind us, and then new restocking cycle is underway. And why it's so important is because that's when the really large amounts of uranium get purchased under these long-term contracts. So everyone is always looking for signals around inventory levels and long-term contracting. It seems to us there's a bit of a disconnect between the uncovered requirements that utilities have going out the last few years and what they've been doing the last few years with their inventory levels. As you mentioned, inventory levels appear, based on this report, that they're kind of flat over the last 2 years, with the exception of China. Now, why has China been so aggressively adding to their stockpiles? Well, they're building between 4 and 6 new reactors each year. And it seems as though every few months they have another news release about another batch of reactors that have been approved for construction. So they are stockpiling material in anticipation of a very large build out. Now, the rest of the world obviously is not building out new reactors to the same degree. And so, but they're just maintaining their current levels. We like to think that these utilities should be accelerating their purchases because they have not been essentially replacing the amount of uranium they've been consuming the last few years. And given all the geopolitical uncertainty and the changes in the uranium market, we think there are heightened risks right now to the overall supply chain. So we hope that the contracting cycle accelerates in the back half of this year and into next year, because quite frankly, it's been very, very quiet for the first 6 months of this year.
So the utilities are letting their inventory levels drop down. What about the producers? What are you hearing about them?
Well, the producers are running also very low levels of inventory. I mean, just a week or so ago, Kazatomprom said that their inventories on hand were down to 4 months equivalent production. That's historically a very low number. And that's because they're selling more uranium, and legacy contracts that they had on the books had certain flex options where customers could increase the amount of uranium they would take under the contract terms. And that's, I think, pushed down inventory levels. So I think everybody needs to start building up inventories again, whether it's producers or utilities, because if you look at the WNA data that was released last year, we need 300 million pounds of uranium in the year 2040 to meet all of the anticipated reactor builds. You contrast that against production this year, which might be 150 million odd pounds. There is a huge, huge gap there that needs to be solved ultimately through new mine builds, which are going to require higher prices than where we are right now.
John, another interesting point that happened this year was a number of U.S. brokers have initiated coverage on the uranium sector. And I'm thinking about Citibank, Morgan Stanley, Bank of America, all of which are bullish on the entire sector. Has this helped create more interest, especially from the U.S.?
Yeah, absolutely. I think it's fair to say that in the bear market, not many uranium analysts survived. Very few people were covering the sector anymore. So there was a huge gap of institutional knowledge. And I think that's one of the opportunities which we took advantage of when we entered the space in 2021, realizing that there wasn't a lot of institutional coverage, which is why, we do so many of these interviews, we do so many road shows, really trying to educate institutional investors. And the reason why the coverage is coming back is because the interest is coming back, and people are connecting the dots around uranium's role and obviously in nuclear energy and its importance in electrification, decarbonization, reliable baseload power, how that's helping power the grid because the grid is becoming ever more unstable. And renewables, have big connection queues, meaning, there's projects that are waiting years to connect into the grid. So all of the existing nuclear power stations we have are really providing that backbone energy for all the key industries. And obviously there's a expected growth in electricity coming from reshoring of manufacturing, as well as things like AI data centers, which are very energy intense.
There's a lot of chatter online about whether or not Sprott can sell pounds into the open market or also loan their pounds out. Can you speak to this?
Yeah, it kind of comes and goes in terms of rumors and people speculating whether the pounds that are sitting in the trust would be available to them, whether they're a producer or a trader or a utility. And, we try our best to help out the industry by doing things like location swaps. Those have been very popular, particularly as some of the facilities in the nuclear fuel supply chain have come back online. For example, Commodine. We've done a number of those. We've done some origin swaps, but we have not sold a single pound in the market. We have not lent any material to anybody, and that's not part of the mandate of the fund. And it's important to reiterate this message because sometimes I think utilities come to this conclusion in their head that somehow our pounds will be mobile. And it's not a vehicle designed to do that. It's a perpetual trust. Our incentive at Sprott is to grow the vehicle and make it as liquid as possible for institutional investors. So, I kind of hate sounding like a broken record, but I find that I have to talk about this all the time because it does flare up from time to time. And I think it's important to remind people what the intent of the vehicle is.
So if our utility has a strategy of hope, they should not be hoping.
Yeah, they should not be hoping. I love that quote. Please get in line and buy uranium like we have the last few years. And they have every incentive to. And I think it's important that they work obviously constructively with the industry to ensure there's long-term security of supply. And I can tell you, there was not going to be long-term security of supply. The price today was at 30 or 40 pounds. We would not have the new mine builds. We would not have the restarts that have happened. And the industry would be at risk in terms of being able to achieve its very ambitious expansion plans around the globe.
John, as we wrap up, what message would you like to convey to investors who might be concerned about the recent weakness we've seen in the uranium price?
Yeah, well, obviously last year was a breakout year for uranium. The price went up 89%. And again, a lot of it happened in the last few months of the year. And I remember very vividly talking to investors in July of 2023, and a lot of them were down and out and were kind of washed out. And some of them that I talked to said they threw in the towel and they moved on. And then lo and behold, you have a few little bits of news and catalysts and the sector goes. It feels like we've had after, a big move last year, we've had a pause. As I said, there's been a lot of mixed messages from some of the producers, which I think has created a whole lot of confusion around what is really going on. And everyone's been kind of waiting and seeing looking for more signals in the market before they make the next move. So what we tell people all the time is you shouldn't be investing in the sector. You've got a short-term horizon. That's just not the right way to approach it. You're going to be disappointed. You need to take a 2, 3, or 4 year time frame in mind because the fundamentals over that period look amazing. And so the noise is there, the market volatility that is macro-related or interest rate or geopolitically related is going to flush some people out. And that's unfortunate because I think the fundamentals are going to win the day in time.
Always good to end on a positive note. John, thank you very much for spending time with us today.
Thanks for having me. Enjoy the conference.
David, thank you very much for joining us today. You've been extremely busy over the last few days, meeting with numerous people. Give us a sense of who you're meeting with. Are they investors, utilities?
Jimmy, at the WNA, this conference, we meet with a lot of people. Our focus, though, is on the utility side right now. But we are also seeing investor interest at the same time. So we've got a pretty mixed group. Some industry meetings as well, more on the business relationships, not just commercial. So it's a great conference for us to be able to cover all the bases with all the key people in the space.
And when I look at this year's event versus last year's, it seems to me like there's a lot more buy-side interest. Some of the world's largest investment funds are here this year.
Yeah, so I'd agree with that. I've been coming to the conference for several years. What we used to see on the investor side was like the deep uranium specialty niche investors. They'd be here in the back or in the front of some of the conference rooms and asking questions and trying to, dig more into the space. What we've got more now is generalists, much larger investors that are not specialty. And they're looking at this whole, not just uranium, they're looking at nuclear energy broadly. They're looking at how it fits in the clean energy transition. So that is a big change from when I started coming to this conference, absolutely.
So when we spoke at this event this time last year, the big news from Denison was the feasibility study at Phoenix.
Yes.
And then you were moving toward a construction decision. Maybe you can take us back a little bit and tell us what you and your team have accomplished in the last 12 months at Phoenix.
Yeah, no, thanks a lot. I mean, Jimmy, we had been working for about 4 or 5 years after completion of our pre-feasibility, where we picked in-situ recovery mining for the Phoenix deposit, which is part of our Wheeler River property. And we put out a feasibility study in June of last year. And let's say in the last 12, 15, 16 months, I mean, it's been incredibly busy as we've moved immediately through completion of front-end engineering design, a lot of which actually we had completed as part of the feasibility study. And so we were able to quickly complete FEED and transition immediately into detailed design. And so we updated with our Q2 results that at the end of June in this year, we had already achieved over 30% total engineering. So engineering team is humming along, and that's going to ramp up even further because we are targeting final investment decision in the middle of next year. Now, in parallel to that, we started a program of long lead procurement. So we raised some money late last year, really bolstered our balance sheet, knowing that we'd head into this year starting to acquire some of our actual initial CapEx. So we've got about a $10 to $12 million budget this year as part of our bigger budget, actually securing, making deposits and acquiring long lead items based on all of that feed work that we've got outlining when we need things and what the lead times are. So that work has kicked off full steam this year. And then, of course, multiple tracks of things going on. We're also moving the regulatory forward. So years into the environmental assessment process, but we've made some really significant progress towards finalization of the environmental impact statement approvals by both the province and the federal government. So late 2023, we heard from the province that our EIS met their requirements and we could submit it as final if we wanted to. We haven't because we're working towards synchronizing it with the federal EIS review. We haven't seen the provincial approval as changing the critical path to this point. But, that could change. And, but we are making very good progress also on the federal review. So a lot of people are watching the information requests and the public disclosures on these EISs. We are really getting that number of outstanding items down to quite a low level. And we're optimistic that we can be finalizing that shortly. So hopefully that's a 2024 item that we can close. And then sort of that last stream of work over the last 12 months has been project finance related and commercial discussions with utilities. As we approach that FID, we want to be prepared to fund the project. We've got a very strong balance sheet, but we still need some additional capital. And we need customers to be able to sell our product to, not in the not too distant future. So those discussions, like we talked about, are happening here at the conference. And we've been making significant progress building our team on the commercial side and our presence with the utilities. So as you can sense, quite a lot going on in a short period of time.
As you and I both know, the engineering process will be very complex, and you made mention of the fact that it's already 30% complete. How are you able to advance the project so fast in such a short period of time?
We spent quite a lot of time doing technical de-risking at a really rigorous level from our 2018 pre-feasibility study. And so that involved, actually initiating FEED before we completed the 2023 feasibility study. And so the work we put in advance has set us up now to move quickly forward. And so we haven't stopped. We went straight through FEED, finished the feasibility study partway through, and immediately transitioned into detailed design. We've had the same team working on it the entire time, and we started with a really detailed base of technical work in the first place. So we haven't had to do major new scopes of studies. We've really been able to focus on just the engineering. And so being right now at 30% total engineering within a year, that probably is faster than we're seeing others, and it may be a year or even 2 years faster than we're seeing others. Another element of it is our project. So our project is inherently simpler than most mining projects. We are not sinking a major shaft or opening up a big pit. So the level of engineering design and work that goes into that sort of scope is different than what we're doing with boreholes and wells with ISR. Our process plant is actually a pretty straightforward facility. We're only doing the back third of what you'd see in a conventional mill. So all of that also helps us be able to move the engineering forward faster. We just have a smaller scope of work than you'd see with something that's more like a mega project.
So let's talk about inflation. And as we both know, inflation has impacted every aspect of the mining industry. And even though the feasibility study was done in 2023, do you anticipate any further changes to CapEx or OpEx because of inflation?
Yeah, well, we're certainly going to see changes. Taking the engineering design all the way through to 100% ready for construction, numbers are going to be different, and you're going to make choices that are maybe different than the feasibility study in certain areas. But generally, we're not expecting to see a major impact from inflation. The reality is we saw already a very significant impact from inflation in our 2023 feasibility study. And we did have some design changes in there as well, which were positive to offset some of the inflation. But we took quite a lot in terms of inflationary increases already. And so I think that is a really key differentiator for us right now, is the fact that our study already took that wave. It was really 2021 to 2023 where we saw that really significant wave of inflation. The other part with our project is, because inflation is tricky, that's like a direct drive on cost of things. The studies often see, let's say, cost inflation, not from the cost of money, but from design refinements, depending on the level of effort that goes into the design at these different study stages. One thing that we've done that's been really useful for us to manage costs increasing is having completed the environmental assessment work before we did the feasibility study. So in our case, we already went through years of environmental studies. We already had an idea of what our envelope would be from possible environmental impacts and how we would have to achieve it with things like water treatment and plant design. So as much as we could, that was already reflected in the feasibility study. If you switch that order, you've got a design in your study that you think is feasible, but then you go through a few years of environmental assessments and you realize, well, it's actually a little more complicated than that. We're going to have to do this, this, and that. Okay, well, we don't have that in the study. All of a sudden that gets in there, and that could be a driver of cost change. So by sequencing it the way we have, I think we've also minimized the risk of significant change.
So let's discuss the timeline. When do you anticipate construction and production?
Yeah, our next key milestone is final investment decision, and our objective is the middle of 2025 for that. The multiple streams competing on potentially on the critical path, but really the critical path to that is permitting. So we're hoping to finalize the environmental impact statement approvals by CNSC staff this year, with a view of then having commission hearing and approvals next year to allow us to make that final investment decision. We have about a 2-year construction timeline, so that would put us on track for first production end of 27, beginning of 28. Now, all of this is actually quite consistent with what we've guided from the beginning. When we submitted the draft EIS in October 22, we said it would be 2 to 3 years. We're still on track with that. When we put the feasibility study out last year, our guidance and our official guidance on first production is still 2027 into 2028. So all of that's intact, but really it's that FID next year that sets that all in motion, and that's what we're focusing the whole team on right now.
Exciting times.
Well, it's been a long road, and we're getting very close.
So the other big news that was released earlier this year was McClean Lake Mine. And Denison, along with its partner, Urenco, has made the decision to restart the mine. Take us through this process, what it exactly entails, and what would be the timeline moving toward production.
Yeah, so McClean Lake, joint venture with Urenco Group from France. Denison's in at 22.5%. We've talked about McClean Lake for the last several years, but primarily because of the mill. We have a real world-class milling facility there, processes high-grade ores without dilution, has excess license capacity on top of the material it's processing from Cigar Lake under a toll milling agreement. And that's pretty much what we've been talking about. But yes, this year, we got an opportunity to remind everyone that we actually have unmined deposits at McClean Lake. And we did make a decision with Urenco to restart mining. So we have a proprietary mining method that the McClean Lake joint venture has developed over the last 2 decades. It's called the SABRE method. So that's surface access borehole resource extraction. Very exciting. But essentially, we're able to mine from surface. We're able to mine high-value, high-grade cavities using jet boring from a surface drill rig. So really minimal environmental footprint, and also quite nimble. So little in the way of fixed infrastructure. And so that has allowed us to make an assessment on several of the smaller pods or deposits at McClean Lake, and determine that, look, this is an economic mining method. It's been commercially tested by the joint venture, and we've achieved rates of production through these commercial tests that we've used to then determine whether we can do this economically. So what it means right now for us is 2024, we're doing a sort of restart preparation program where we're getting the equipment and all the facilities that we already own back into working order. No major CapEx to get this project going, but also some development drilling. And you basically have to drill a pilot hole into the ore body area in 1 year, and then in the next year you come back in with the specialized tooling and you actually mine out the cavity using that SABRE technology. So pilot holes this year, and then 2025 we'll start extraction of the first pounds there. And the idea is that we're projecting around 800,000 pounds production in 25, so our share is just under 200,000 pounds. And then we're going to continue that pattern of pilot holes and then mining extraction in a staggered manner for the next 5 or 6 years. We're trying to approach another 3 million pounds of production at the McClean North deposit primarily. So this is pretty exciting for us. It'll be our first, return to active production in quite some time, but it's also really useful additional cash flow as we approach that investment decision on Phoenix. And so this will be a positive project, and it's going to generate, several $1 million of positive cash flow for us at a good time.
And so it's going to start producing relatively quick.
We'll be producing and selling uranium in 2025.
In addition to Wheeler and McClean Lake, you will have a number of other assets in your portfolio. Why don't you take us through a couple of those assets, starting with Waterbury?
Well, Jimmy, we're really bullish on the sector and the cycle. And so while we have a laser focus on getting Phoenix built and generating all this enormous free cash flow that it's projected to produce, we have firsthand experience knowing that it takes time to get assets into production. And so we are working on 2 other major fronts, on the development side as well as on the exploration side. For us, a new discovery of high-grade pounds anywhere near that Phoenix plant has incredible potential to add value to our company as a satellite operation. So exploration continues to be an important focus. $10 to $12 million a year, earmarked for exploration on high-priority projects and targets. If we hit on one of those things in a meaningful way, of course, we'll accelerate that to bring that value right up forward. But on the development side, we're working on 2 projects right now that are pretty exciting. Both are ISR focused, which is our specialty. One is Waterbury Lake. We have the THT deposit there. This is a project where we're in partnership with KHNP, which is here at the show. They're the South Korean nuclear utility, state-owned, and they're our largest company shareholder as well. But we carried out some field test work there last year to validate the application of ISR. It was very successful. So now the focus is on taking a 2020 PEA for THT and bringing it forward to a PFS. And so we've got work underway for that. But similarly, we're working on the Midwest project. So here's one where we're a minority owner, partnered with Urenco, again, close to the McLean Mill. And Midwest is a great project, and it's been around quite a long time, actually. And Denison has quite a long history with it. Previously permitted or approved EIS, I should say, for an open pit mine. It's not a very good open pit. It's got a terrible kind of strip ratio, and the project was not advanced. But we're looking at reimagining it both under saber mining and more focused on our end as ISR mining. And so for the last 2 or 3 years, we've been carrying out concept studies and technical evaluations for ISR mining at Midwest on the behalf of the whole joint venture. So we're the minority partner. Urenco acknowledges and actually appreciates that we have built this special skill in considering ISR in the basin, and they've got us doing the work on this project for ISR mining. Earlier this year, we carried out the first field program for ISR test work at Midwest, also very successful, and now we're progressing an internal concept study towards PEA. I'm actually quite excited about Midwest because we really don't have a basis to talk about the economics of ISR at Midwest until we have the PEA. And from the concept study, it's really positive, and we'd like to be able to explain more specifically to everyone how positive Midwest could be and how important a growth project this will be for Urenco as well as Denison. We're 25% at Midwest, but Midwest has the potential, even with it just being 25% Denison, to be a really significant asset in our mix.
So you have a lot going on, which is going to require a lot of capital. So let's discuss your balance sheet. You currently have $121 million in cash and cash equivalents, have zero debt, and you still have 2.2 million pounds of uranium. You sold down a little bit of uranium.
Yeah.
Maybe you can tell us the rationale for doing so.
Well, look, the balance sheet is an incredible strength for us. I mean, you put all those pieces together, we're $400 million of value at the end of our second quarter. Our capex at Phoenix is around $400 million. So there's very few, I would say, /no development companies that are pre-permitting, pre-project financing that are sitting with a balance sheet where they're essentially fully funded for their initial capex. That gives us great confidence to move forward. What we're doing here is really now working on the fringes of this. We do need some additional funding to be able to carry out our other project work and construct Phoenix, but the amount's small relative to our market cap and relative to the project. It's very attainable, and so we're focused on optimizing that. We do like credit for it. We think our project's well suited for credit, and with us being debt free, we're in a good spot to be able to take on some credit. Essentially, it's just filling in around the edges on the balance sheet side. And with our physical uranium, it's an incredible asset for us to be able to use to fund Phoenix. And I know that there's sort of a mixed view on that. Surely you think the price of uranium is going up, and why would you want to sell it? Well, look, I hate to break it to everyone, but we are in the uranium mining development business, so our objective is to sell uranium. Generally, we've had an incredible return on our physical uranium. We purchased it at a price under $30 a pound. We're not looking to put it into the spot market. I personally have quite a lot of experience in the spot market from my time as CEO of Uranium Participation Corp, which became the Sprott Physical Trust. So we're aware of how to properly move material in the market without an adverse effect. We're talking about finding a responsible way to monetize, say, 2 million pounds to access 9 million pounds a year of production at a $16 all-in cost. Like, the return on that trade is incredibly positive for us. Our focus is on the majority of those pounds going into customer hands as part of our commercial negotiations, not for those pounds to flood the spot market and defeat our own objectives. We understand how that all works, and we're going to be very diligent about making sure that we raise our money at the best cost of capital for our shareholders without having an adverse effect on our own efforts to sell the rest of our production. So carefully being done, but it's an incredibly positive situation for us and our shareholders. I mean, the risk of significant equity dilution from our company is incredibly low, and that's very unusual for a non-cash flowing mine development company. Dilution risk is normally number one when you look at that. So I do think we've found a great spot, and our balance sheet is really an important attribute.
David, the CEO from Urenco spoke at one of the panel meetings this week, and he was stressing the importance of exploration, and he also mentioned doing further exploration in Canada. Do you think this is a trend that's going to continue? And maybe you could also speak to the importance of jurisdiction. Well,
look, I'm really encouraged to hear that. Urenco is quite a good partner. They have long-term vision. Okay, Jimmy, they're in this business like forever. They look at it as a forever business. You think of where they come from in France. I mean, how much of their power is coming from nuclear? It's like 60-70%. So they have a really close connection to this, and they're in this business for the long run. And exploration is important. We're in a depleting business, right? Like the resource business, you find deposits, you mine them, they're gone. You have to replace them. Exploration's how you start doing that. They're in a spot where they should be working on exploration, and then you have choices of where do you do it. Of course, we think Canada and Saskatchewan's a great place to work, and I'm sure they're doing the same sort of calculus and seeing we've got a combination of high grades and really a stable, reliable geopolitical environment. Facts are, where is the uranium in this world? And the uranium's not in the best places. It's in Canada, and it's really high grade and can be very profitable. That's all tick, tick, tick. Other places we have it, we have Kazakhstan, we have in Niger, and we've got, the Mongolias and then there's Australia as well, where we're not even allowed to mine it. So, put that list together, and if you had to pick where you'd want to do it, I think you'd pick high grades and stable, mature, regulatory, geopolitical environment like Saskatchewan, Canada. So makes perfect sense. They already have a significant footprint in Saskatchewan, and we're seeing investment from the world's biggest mining company with BHP and Jansen in Saskatchewan. It's a great place to do business, and it doesn't surprise me at all that that's where they'd want to focus on the exploration side of things.
David, as we wrap up, you've already summarized a lot of what's going to happen here in the coming months, but as we go into year-end, maybe you can just provide a few elements of what shareholders should be expecting in terms of news flow.
Yeah, I mean, we have a lot going on. We've covered a good portion of it, but I'd say we do have some significant news coming in the pipeline. We've got technical studies at Midwest and THT Waterbury, which are really could be quite notable. We have continued exploration work through the fall, and as I mentioned, any new hits or expansion of a high grade area near Phoenix would be really meaningful for us. And we have all those milestones on Wheeler. So the environmental assessment review process, that'd be really material to get that EIS through the federal review and a commission hearing scheduled. Then we could start to really narrow the schedule down and our efforts on the commercial contracting side at the same time. So quite a lot going on, and some really notable specific items that could materialize by the end of the year. So incredibly exciting time in our sector and incredibly exciting time for our company.
Well, David, that was a great overview, and I want to thank you very much for spending time with us today, and good luck with the rest of your meetings.
Oh, Jimmy, thanks very much for having us. We're really happy to be here at the conference, and we really appreciate the work you're doing to be here and bringing stories right from the conference floor to the people who are following our space. So thanks very much for that as well.
Here, thank you very much for joining us in London.
Oh, thanks. Jimmy, to be here. It's always a good time of the year to be in London here.
I am looking forward to this discussion. So WMC is involved in the buying and selling of uranium for its various clients. So therefore you have great insight and great intel on what's happening within the spot market and the term market. And I want to get your views on why we've seen so much weakness this year in the spot uranium price in spite of this very positive backdrop And do not tell me there's been more sellers than buyers. I want to hear more detail than that.
Sure. At the beginning of the year, we're at 90, slightly over $90, and it went all the way up to 107. So there was some strength early in the year. Of course, after that, it's dropped off a little bit, where it's sitting about 80 today. So if you don't want me to have that, to make it that simple, I think it's all eyes are on Kazakhstan. Obviously, they're producing 40% of the uranium in the world, and whatever happens there is going to influence the sentiment in the market. So I think there was not much clarity on what's going to happen in 2025. They had some better production numbers than what people were expecting earlier in the year. Some people were expecting Cameco to have their production down, but they're actually doing really well. So I think there wasn't the immediate shortage that people were expecting, or some people were expecting. And I think what also has happened is that because of some uncertainty around the Russia ban or the ban of Russian uranium enriched uranium in the U.S., a lot of U.S. utilities kind of stepped back from the procurement process to sort of wait and see and get some clarity on that. So it simply hasn't been as much contracting done as a regular year. That's probably the easiest way to say it.
So let's quantify that. When you say there hasn't been as much contracting, how many pounds have traded so far in the spot market year to date?
The spot market is about just under 30 million pounds, and that's tracking, say, 10, 20 million pounds, maybe below what you would see on a normal or busy year. So it's definitely been lighter, but I think it is that, producers haven't really been active, utilities haven't really been there, and it's just been a lot of uncertainty. People don't really know people are waiting for indicators to see which direction is the market going to go. So it's been a bit of a waiting game.
So 30 million pounds, and how does that compare to last year? How many pounds traded in all of 2023?
In the spot market, I don't know, it's maybe 70 million pounds, still around 60 million pounds. So it's just a little bit less, but we don't know what's going to happen the rest of Q3 and Q4. So I think it's going to be pretty busy, but it remains to be seen.
And what's happening right now in the spot market? Are there a lot of sellers at a particular level, or are there a lot of buyers lower down?
No, it's just really hasn't been that much activity. You have a few sellers. You always have some material coming to the market and looking for a home, and it's just the summer is always very quiet. It happened last year, happened year before that. So it's sort of this conference here in London kind of kicks off the fall session. So will be really interesting to see what happens over the next few weeks. But adding to that is also that obviously utilities, especially in the US, have been waiting on DOE to clarify the waiver process and what's going to happen there. And now that they have that clarity, I think there will be a few coming to the market there.
So if somebody came into the spot market today and they wanted to buy 500,000 pounds, could they do so?
Sure, yeah, that's it. Don't know exactly what the price we're going to buy it at, and it's not like you would get a bunch of offers thrown at you, chunks of 500,000 pounds, but I think you can buy 500,000 pounds, yeah.
Without taking the price up too much?
It'll probably go up a buck or two, that I'm fairly certain of, but yeah.
So that's a good overview of what's happening in the spot market. But what about the term market? How many pounds have traded year to date, and how does that compare to last year?
Then it started trading, then because it's not delivered, you can say more contracted for, and I think we're just over 40 million pounds, which is, I would say, very light, lighter than expected. And as I referred to with the waiver process in the US, there's not been much certainty there. That's one of the reasons why a good portion of the market hasn't been as active to date. And last year we had in total 160 million pounds, which was the biggest year for quite some time. But it does not seem like we're going to get there this year. And there can be a row of factors for that. But overall, there's been light contracting volumes for the last 10 years almost. So I think we are in the beginning of a contracting cycle. And there are just a lot of factors outside of the regular market that is impacting things, and utilities take their time and think about how are we gonna adapt to, because it's a very unique situation with the market what's going on in Russia, and clearly now both European and US utilities are instructed more or less to not be as dependent on Russian products. The interesting factor here is that the Russians have conversion and enrichments. That's their main That's where they have 30% of the commercial market, 40% of the enrichment market, but they're not very big in uranium. So if you're a utility and your main concern is conversion and enrichment, so that's what you focus on first, and then you worry about uranium. And we've seen very big movements in both conversion and enrichment. So I don't know if we're going to see exactly those big movements in uranium because it's not a Russian product, if you will. But it's still, I still think that there will be contracting activity slip over into focus on U3 waste rather than the services.
I'm glad you brought that point up because we have seen big moves in both enrichment and also conversion. They're both trading at or near all-time highs. And is this a precursor to what might happen in the spot price? Can I make the assumption that the spot price is going to also go up because of these other elements within the fuel cycle?
I wouldn't say it's not a direct line between the two, but because of the Russian angle here and the potential shortfall or shortage in conversion and enrichment, that's why people have contracted for that first. And if you contract for those services, you'll need uranium to feed into those contracts, so you will have to contract for the uranium as well. Connection between term activity and spot price, it's also not a given. We've had backwardation for some time where the spot price has been higher than the term price, which means that you can't do a carry trade. So if you're an intermediary, you buy in the spot market, you finance it, and you sell it out in time to a utility, and you don't necessarily take on any risk. You do those simultaneously. But then you have a connection between the term price because you take the spot price, escalate it, and then that's your term price. But if you have backwardation, you can't do it. But now when we have spot price being fairly soft compared to what it has been before, there's talk of potentially rates coming down, being cut, and the term price is as high as it's been for a very long time. So it's starting to make that carry trade a potential option for intermediaries such as ourselves.
And so the carry trade, once again, that's going to be positive for the spot price.
It should be, for sure, yes.
So I want to ask you one more question about the contracting price. So you said 44 million pounds have been contracted so far this year versus 160 million pounds last year. That's a huge increase or a big difference. And UxC recently came out with a research report on inventory levels held by utilities in the US, Europe, and also in Asia. And one of the trends that they saw in the last couple of years, US utilities only acquired 2 million pounds approximately. Europeans, very similar amount, whereas the Chinese, I think it was 80 million pounds. But why do you think the utilities are holding back in acquiring inventory this year?
I think, especially on the U.S. angle, it's what I referred to before with the ban on Russian low-enriched uranium. So because they needed clarity on the waiver process first, once they have that clarity, then they can come back into the market and do some procurement. So I think that's the main reason why you haven't seen more contracting on the U.S. side. As far as Europe goes, it ebbs and flows. It was a very large contract last year for the Ukrainian fleet that I would say in a way distorted the numbers a little bit. So it looks like it's a very large difference. But it's also, you have some of those chunkier contracts every now and then. So shouldn't stare ourselves blind at that 160 numbers and just say that nothing has been happening at all today. And it's also a very long process. Like I was working for Chemical for a long time, and when you negotiate a big contract like that, you got to agree on terms that can take up to 6 months sometimes, and then you got to negotiate a contract that can be another 6 months. So from start to finish, you can easily talk about a year, and you don't necessarily report anything until the contract is inked. So there could be a lot of things in the pipeline that we simply don't see, and my hunch is that there is a lot of discussions going on right now, but not everything is reported in a timely manner, and some things, quite frankly, aren't reported at all. So it's the only number that is readily available, so that's what we have to look at, but it's not showing the whole picture.
And can you speak to the RFP market? Are there many out there right now, and if so, what is the size and what are the terms?
I can't go into specifics because they're very proprietary, but it's not completely quiet. Normally you see a quiet period over the summer, but already a few weeks ago, some activity started, especially from U.S. utilities. So that is definitely something we're starting to see early signs of, and we expect it to keep going for the coming months.
And Pierre, I'm wondering, with all these new financial participants in the marketplace that are playing the spot market, has this created more volatility? And when I ask that question, I'm thinking about 2023 specifically. At the end of the year, we had the big move up from $50 up to $90. And was that because of these new financial participants as opposed to real players?
I think the fundamental supply demand still drove the market from 50 to 90, but clearly the speed at which it's happened was probably augmented by some of these new entrants. But in general, you have a healthier marketplace if you have more people active in it. But it is hard to get a read on the market. You can have your supply-demand fundamentals models, but it is really hard to get any good information, and especially that some of the big producers have been a little bit less forthcoming in what the production numbers are. So it's just harder to get a read on it. And it was, I think a few people got scared early in the year and maybe backed away a little bit. They thought like, oh, this is a great thesis, a good story. It had all the good news from COP, and we had all-time prices or prices that were the highest for a decade or two. And so that kind of got a lot of excitement. And then I think when they realized and started digging into a little deeper to it, it's like, oh, it's very hard to get a read on this. And some of them probably stepped out a little bit. But it's still, overall, the more actors in the market, the better it is, I think. Some of them haven't been that active yet, but they're still ready to go and still following the market. And some of them have been quite active. Some of the new entrants we didn't see a few years ago, they are now in there and they're providing liquidity. And I think it's a sign of a healthy market when you have new entrants coming into it.
But the only thing is, when you get these financial players, whether they're hedge funds or traders or whatever, they can create a lot of volatility. And I think right now, especially that we're seeing this weakness in the global economy and a pullback in the S&P and the NASDAQ, when they start selling, they sell everything, even if they are really bullish on it, like they might be on uranium. Mm-hmm. But do you think this is one of the reasons why we might be seeing some weakness this year?
I think the main weakness has probably been in the equity market. It's sure, we're back down from a high of 107, but there was a very sharp spike up there. And now we've been hovering around mid to low 80s for a few months when it's been very, very quiet in the market. And to a certain extent, I think almost see that as a sign of strength for the uranium price anyway, that it hasn't slipped below that. It seems to be a support level there. And sure, it's a 7 in front of the price for the last couple of days, but I don't think it will last very long, and it's certainly not a lot below 80. So that market has actually been pretty stable. So I think it's much more volatility on the equity side of things.
So I'm going to put you on the spot now. Uranium's trading around $80 a pound. Where are we going to be a year is?
Oh yeah, well, that's how you do put me on the spot. I would say we're in the 90s. I'll call it conservative, but that's I feel that's I'm expecting it up from here anyway.
Pierre, as we wrap, what message would you like to convey to investors who might be concerned with the pullback that we've seen here in the last few months of the uranium price?
I would say, yeah, if they haven't discovered it already, the uranium industry in particular, like the nuclear industry, but it's very quirky. It is extremely slow. So it would be almost like don't look at the screens that often. Get a hobby, and I guess we're in a very good spot. The fundamentals are all pointing in one direction. It's gonna stay like this for years to come, but it might not be those daily changes that you're expecting. And you hear big bullish news one day, and then the next day the spot price does something different. Take a step back and just take a few deep breaths. Take it on a weekly level or even more sometimes, and just we're in a very good spot. But yeah, just have patience. That's probably my best advice.
Well, Pierre, that was a great overview, and thank you very much for spending time with us today.
Thanks for having me.
Katie, thank you very much for joining us today. You have a very interesting background in that you're a research analyst, not for one, but for two different sectors, uranium and lithium. And given that we're at the World Nuclear Symposium, I got to ask you about uranium. What is your view on the current uranium price, and where do you see it going in 2025?
Yeah, it's a good question. I think first we need to clarify what uranium price we're talking about. If we're talking about the spot price, I would argue that it's been incredibly volatile, especially over the last 12 months. If you think of last year, we had a large run-up in pricing over the fall, end of the year at $91 a pound. It felt like that momentum was going to continue. It did into January, February. Uranium prices peaked at 107. We've now since seen a pullback to $80 a pound. I think what's important for everyone to understand is that the spot market you're talking about, and over the last 12 months, it's been moving on very little volume. So because it's so thin, you've seen the price move from 107 down to 80 on 250,000 pounds. It's these low volumes that are causing this volatility, but I do think it's an important market that we need to talk about, because being on the sell side, when I'm talking to a lot of investors, the spot market is the price they focus on, even though it is not the fundamental price in my view. So the spot price, I think, could continue to be volatile, but I think directionally will likely continue its trend upwards. And in my view, that will be driven by some of the momentum we're starting to see in the term market. So when I'm talking about the term price, what we've seen there is a continued grind higher over the last couple of years. And even year to date, while volumes are down about 70% relative to last year at this time, what we've continued to see is price discovery to the upside on very little volume. And I think that's something that's going to continue. So right now, the term price is around $79 a pound. When I talk to industry participants, a lot of discussions are happening at higher levels. So I think of the current term price as a backwards-looking historic indicator with a lot of discussions happening at higher levels. So my view is the term price over the next year will likely continue to grind higher.
And let's talk about your valuation method now. When you look at a producer like Kazatomprom or Cameco, how do you value those companies versus a developer like NexGen or Denison?
Yeah, no, it's a good question, especially because there are very few publicly listed producers. That will change over the next 12 months. We're seeing a number of projects ramp up, so I think that will be good, especially for investors who are looking for, pure play producer exposure. For the producers, Cameco, Kazatomprom, we value them on a blended method. So we look at discounted cash flows, PNAV, and then we also look at current EBITDA multiples, and we use that blend to create our target price. When we look at developers, which is the majority of our coverage, just given the nature of the equities, we do a lot of valuations using discounted cash flows, taking the existing mine plans, I would say increasing capital costs, operating cost estimates where we deem fit, as well as extending timelines where we think it's appropriate. And then we use a PNAV multiple for that as well. So we use 1x NAV for developer coverage, and then the producer coverage, we take into account current multiples.
And what long-term uranium price do you use to value your companies?
Yeah, we're using $90 a pound long-term, so slightly above the current term price. In our view, that's underpinned by two things. One, where we view the current cost curve as being today, but two, where current term contract discussions are happening. So if I think about this time last year, term contract discussions were happening at, floors of 50, ceilings of 80. Today, we have floor discussions happening around spot, $75, $80 a pound, ceilings, $125, $130. So directionally, I think that's going up, and I think $90 a pound long-term is actually a quite conservative estimate for what the pricing could be.
So we've seen some pressure in the spot price this year. It's down 15%, give or take, on the year. A lot of equities are down that and more. Do you see good value at these current levels?
Oh, I see.
Equities that you cover?
I see immense value at these levels. I think there's a number of namers that I cover that are trading at the same levels as they were this time last year when the uranium spot price was $60 a pound. And you can see it in the implied pricing for the names. So when I look at some of my advanced developers, let's say NexGen, Denison, these great projects that are on the cusp of getting their federal permits, I have those names implying a uranium price today in the low 60s. 3-4 months ago, before the recent pullback, they were, low 80s, more in line with what spot pricing was at the time. So yeah, I think there's good value in the names.
So I want to ask you about M&A now. We've seen a lot of very aggressive M&A transactions in many parts of the resource sector. Exxon just acquired Pioneer for $60 billion. Newmont acquired Newcrest for, I believe it was 15 or 16 billion. And BHP just spent $4 billion on Filo, which is at an elevation of 15,000 feet and won't be built for another 10 or 15 years. Why haven't we seen some aggressive transactions occurring in the uranium sector? Why hasn't somebody spent $5 billion or more on a transaction?
Yeah, it's a good question. I would say twofold. We have seen some transactions happen. They've been at smaller levels among some of the developers or projects that are looking to restart. We've seen some transactions that are more broader fuel cycle. So we can't forget about Cameco investing or buying, their portion of Westinghouse. I think that was a massive transaction for the sector. And I think that's something that Cameco is still absorbing. So I think that also leads into the question of, well, why haven't we seen some of the bigger players in the uranium space look to acquire down cap? I think it's twofold. It's one, they already have, great assets that they're in the process of ramping up as it pertains to Cameco, but also they just did the Westinghouse transaction. So that was a large transaction for them. I think they're, getting to understand that business and grow that business, and that's their primary focus right now. In addition to the fact that they do have a lot of brownfield projects that they could look to push forward. So I don't think they're in a position where they're desperate to acquire something at this point because they already have enough growth going on. Not to say they're not looking, but I think that's why we haven't seen M&A year to date. I do think that going forward, though, it wouldn't be surprising to see some other majors, maybe majors outside of the uranium sector. I think some of the large diversified miners take a look at the sector. I think they see the global transition to decarbonization. I think they see how nuclear has now been viewed as an important part of our energy mix on a go-forward basis. And I think as some of those companies look to green, like you mentioned BHP buying Filo in the copper space, I think that hints at what some of these major diversified miners are looking at. So I do think, there's an opportunity that some of those players could be looking at uranium more seriously.
So I made mention of the fact that you also cover the lithium sector. And as you know, lithium is down 70 or 80% from its peak. Many stocks are down 80, 90% or more. Do you see a risk of uranium following the lithium price?
Great question, because it's a question I actually get a lot. Like a lot of investors have asked me, is this the next lithium? In the sense where lithium prices skyrocketed and they went completely down the other way. And that created a lot of volatility, and it's created a scenario where the sentiment is so negative in lithium, and I don't know if that's going to change anytime in the near term without, a significant increase on the demand side or a significant recovery in pricing. Why is uranium not the next lithium? I think it's twofold. I think on the demand side, what you had in the lithium market is year-over-year variability in electric vehicle sales growth. So 70% one year, 30% the next year. Those are big numbers. Depending on the magnitude of the growth year-over-year, it could put the market in surplus or deficit. When you look at nuclear, you look at uranium, the growth is stable. So you're seeing it's positive, but it's stable. It's 2 to 3% growth year over year. It's quite predictable. I don't think you're going to get that variability on the demand side. At the same time, it kind of couples with the opposite on the supply side. When I look at the lithium market, it was incredible how much supply could come into the market when pricing rose. So when you saw the 100% increase in pricing, you saw Chinese lepidolite projects come online. You started to see direct shipping ore out of Africa. You're continuing to see some of those projects out of Africa ship material. It was quicker to find, quicker to permit, quicker to bring online. I think the complete opposite is the case in uranium. What we've seen is in uranium is during the bear market, we saw a decade of underinvestment in the sector. The sector is very much feeling the pains of that now, to the point where it's difficult for the incumbent producers, Cameco or Kazatomprom, to grow their production. I think we've seen that with Kazatoprom's most recent results. But beyond that, there are a lot of great development stage projects, but they still need to go through permitting, they still need to go through financing, they still need to get built. And building a large-scale uranium mine is not always an easy thing. And the industry is also heavily regulated. So I think there's not this pocket of supply that can quickly come online in uranium like there was in lithium. So to me, they're very different markets.
Katie, as we wrap up, you and your team market all over the world, meeting with investors, South America, Australia, Europe, US. What's the sentiment like right now? What's the interest like in the uranium sector?
I would say cautiously optimistic. I think there are a lot of investors who over the last couple of years have done the work. They understand the fundamentals. I think they've been a little bit frustrated about the lack of momentum we've seen in the trade over the last couple months. I think that's two things. I think it's summer doldrums, but I also think the broader market is not helping. So there has been sort of this risk-off sentiment. But I think everyone is optimistic. I do think there is, based on the fundamentals, a higher, I would say, likelihood the prices are going to go higher as opposed to lower. So I just think it needs to catch a little bit of momentum, and then you'll see, more of those investors getting back into the sector. One thing I would also note is one, it's broad-based, like you said. It's global. We see a lot of interest out of LATAM, out of Australia, out of Canada, the United States. But what you're also getting is some new large generalist institutional capital who are looking at the space, who haven't really been that active in the last 3 years. So I think if we do get more momentum in the trade over the course of, maybe the back half of this year into 2025 as term volumes increase and pricing continues to recover, I think having some new players enter the space could be really impactful in a sector that is quite small by global standards.
Well, that's a great overview, and I want to thank you very much for spending time with us today, and enjoy your time in London.
Yeah, thanks for having me.
Leigh, thank you very much for joining us. We are both in London for the World Nuclear Symposium, and you're meeting with numerous clients. Maybe you can start off by giving us a little bit of color of who you're meeting with.
Yeah, thanks, Jimmy. Look, it's our busiest conference we've had in NexGen's history this year. Our schedule's totally jammed, and it's a mixture of both investors, existing and also new large generalist investors who are interested in the space, given the demand and supply dynamics of nuclear energy. And then also with respect to our schedule, given the stage of the project, with permitting imminent, followed by construction, we have our highest number of meetings with utilities as well. So for NexGen, this conference, our busiest ever, and a mixture between investors and utilities.
So NexGen is in the final stages of receiving permit approval from the federal government. Where exactly are you in this process right now?
Yes, having received environmental approval from the province of Saskatchewan, where we're located in November of last year, we are now in the final stages of the federal permitting process. We have responded to 49 questions that were raised during the technical review. It's not new information, it's clarification and additional information. We've provided that, and we are expecting a response imminently with respect to those 49 requests. We're very, very confident with respect to the submissions that we have made, and we are expecting finalisation of the environmental impact statement and from the federal government imminently.
So assuming you do get those approvals, what are the next steps?
Next steps after that is construction. And those of you who have been up to site, and we've had quite a few visits over the summer, their main takeaway is that the site is production ready, and construction ready, followed by production. And we've re-gravelled all the roads, we've put in a new bridge, we've got the accommodation camp all set for the construction crew. And literally, Jimmy, we could commence construction the following week following approval. We've also ordered long lead time items. The shaft sinking contractor appointment is imminent after a very long and rigorous assessment process. And we've been adding to the team the expertise consistently since 2014 when we made the discovery, but recently in the last year or so around mine construction, we've been adding to the team, and the team's ready, the project site is ready, and so once we receive that federal approval, we'll be literally the very following week commencing construction.
And Leigh, how many people are at site right now?
It varies. We've got 4 drilling rigs and also construction readiness and various activities. And at the moment, we have just over 100 at site. As I said, the accommodation has been put in to facilitate the construction crew. That's all ready. And the last quarter, the management report, 82% of those at site are from the local communities. So it's incredibly exciting time for the company, but also the local communities as well.
So let's talk about exploration. Earlier this year, NexGen commenced a 30,000 meter drill campaign. And I'm sorry, how many rigs do you have on the go right now?
4 rigs.
4 rigs. So you're very active. And you also announced that you found some mineralization within the Patterson Corridor East. Maybe you can provide some more detail on that.
Yeah, look, lightning strikes twice. It's incredibly exciting. It's located 3.5 kilometers due east of Arrow. It's most likely the same mineralizing event as the Arrow deposit, but it is on an entirely separate conductor. And think of conductors such as like cracks in the ground where the uranium-bearing fluids have flowed. And what's incredibly exciting is naturally everyone says, how does this compare to Arrow? And all we can do in terms of an analog, as we know today, is compare what did Arrow look like at the same stage. And with respect to PCE, the area of mineralization currently is more broader. And also we've hit the high-grade, very intense mineralization, albeit over narrow intercepts, in 4 of those holes that were drilled. At the same stage, Arrow was smaller in terms of extent, and we hadn't hit any high-grade mineralization as we have in 4 holes at PCE. So it'll be interesting, and obviously we're very excited about it. All of these deposits take their own development paths, and as we saw at Arrow, it wasn't until the 30th hole that we then started to really vector in on a high-grade heart, and then from there it expanded dramatically very quickly. At PCE, we have all the characteristics of another incredible resource. The existence of the high-grade mineralization, even albeit over narrow intercepts, suggests, based on what we learned from Arrow, is that we're in the vicinity of a significant mineralizing event. And I can't tell you how many holes it'll be until we do unlock it, but we will unlock it, and very efficiently. But it's a systematic process, and every hole is analysed rigorously to help determine where the next holes go. We will be drilling through till about early to mid-October before the season changes, where we need to stop logistically, and then we'll recommence in the middle of the winter, most likely early January for the winter program. So yeah, incredibly exciting. You can, from the drill rig, you can actually see the production pads for the Arrow shaft, and so it's in very, very close proximity to the Arrow deposit.
Leigh, I've been speaking to a lot of fuel buyers off camera, and a lot of their concern has to do with future production. And though NexGen is still years away from production, are you having these conversations with utility buyers?
Yeah, look, every industry participant has got a real question mark over future production, and we saw just last week, Kazatomprom came out and have revised their 2025 production guidance down by 17%. And they are currently the world's largest producer. So naturally utilities are, looking at their fuel procurement, particularly for 2028 and beyond. And, the uptick in interest that NexGen has received has been very noticeable. I would say it's been noticeable for the last year, almost the anniversary of this conference, and that's been building throughout the last 12 months, and that's included utility visits up to site at the Rook 1 project, and so we have discussions ongoing with a number of utilities behind the scenes, and that is validation that procurement for 2028 and beyond is actually happening now. And with respect to NexGen, the timing of such is, the permit approval is heavily influential on those discussions in terms of timing of deliveries. And we're keeping that that ongoing dialogue with utilities as we speak.
And because of the uncertainty associated with the permit approval, that's also going to lead to uncertainty associated with future production. Is this one of the reasons why you entered into that agreement to acquire 2.7 million pounds of uranium?
Yeah, look, I don't think it's uncertainty as to whether it's an if. It definitely will be approved. It's just as to the timing of such. And everyone can appreciate, procuring nuclear fuel is a time lengthy process, and you can't go back into the past to re-procure. And so having some pounds on hand does facilitate the ability to contract on terms when we do hit production very favourably. And look, when we made that announcement of procuring 2.7 million pounds, we've had new utility interests that we'd had no dialogue with previously arise. And so that really does validate what we were reading in the market, and since that purchase, the Russian uranium ban has come into effect in the US, a ban from 2028 with waivers provided between then and now and then. But those waivers have only been issued for 2025 and 2026, and there's pressure now on the government with respect to the issuing of those waivers. So the landscape in uranium is changing dramatically, particularly in the US. Look, having a project in Canada directly to the north, very friendly neighbour, the opportunity for Canada is enormous to fulfil the US nuclear generation needs. The US produce very little nuclear fuel themselves, have been very heavily reliant on Russia and Russian-influenced countries. And so the opportunity for not just NexGen in Canada, but for advanced development companies such as Denison, UEC, Energy Fuels, the Encores, etc., getting projects into production in the next few years is enormous. The market is enormous. The gap between demand and supply is large and only getting larger. And for that to be filled with Western world supply is not only necessary, but I think it also helps address some sovereign risk associated with the procurement of nuclear fuel.
Yeah, I think you hit the nail on the head there when you talk about geopolitical risk. And most people know that Kazakhstan produces 45% of the world's nuclear, or 45% of the world's uranium production, and there's a big risk associated with that. Meanwhile, the U.S. is the world's largest consumer of uranium, and that's also a big risk for them. And of course, anybody operating in Canada, massive upside, massive opportunity.
Yeah, exactly. And look, we're going through a very long and rigorous permitting process. The barriers to entry are significant. But once you have that permit, you are protected, and it can't be withheld like on a moment's notice. And so we have been working at this since 2014. It's imminent. We had a company internal session just last week, and we're ready for the next stage of our company's development. We will reflect on receiving the approval, no doubt about it, because it will be the first one in over 20 years. However, we are focused on the next steps today, and I think that can't be overlooked. A lot of work's going on in the background, and as I said, we'll reflect on that milestone. But we're immediately on to construction and getting into production and generating cash flows, which will take us into the top 10 mining companies worldwide. And so it's an incredibly exciting proposition for shareholders, but also all stakeholders, and starting with the local communities, the government of Saskatchewan, the government of Canada, certainly does elevate Canada at the negotiating table with the US on other forms of trade. So we are acutely aware of the impact of our project, locally, provincially, Canada, but also more globally. And that awareness reflects the dedication of the team at NexGen. Highly dedicated team that's ready in place to execute on this world-class project.
Well, Leigh, that was a great update and a great overview of what's happening at NexGen, and I want to thank you very much for spending time with us today, and good luck with your meetings in London.
Thank you, Jimmy.
Kevin, thank you very much for joining us today. For those who are familiar with Traxys, why don't you give us a little bit of background on the company, what exactly it does, where it's based, how many employees there are?
Good to be with you today, Jimmy. Yes, Traxys is a large and established trading company. It's been around for nearly 100 years. It does over $10 billion a year in revenue and turnover, trading over 70 different metals, minerals, alloys, essentially the whole periodic table from offices around the world. Almost 500 people, 20-odd offices, nearly every continent, covering the market from sourcing to customers and consumers in the different parts of the world.
70 metals, that's a lot. I didn't realize there was that many. So I'm sure there's a few that you really focus on. What would be the biggest 2 or 3 metals that would generate the biggest revenue?
Base metals business is quite large. Those are big markets, big top line metrics in those markets comparable to an oil or something like that. So in a metals resources context, those markets are quite large. So copper, a little bit of aluminum are very strong markets. But then we also have a very large energy transition business, green energy metals, uranium, things that go into a battery, lithium, nickel, cobalt. We do a lot of those things. So we cover A to Z, a lot of the business.
Lithium has really been under pressure the last 2 years.
It has. The price action has been a little volatile there. It's come down quite substantially there. But I do think ultimately there's growth there. The chart is going to go up and to the right again. And I think it's based off of demand. And I think, it takes a while to build out EV plants and battery factories. So I think of it that, the supply and demand leapfrog each other as this whole thing is growing, and that ultimately the metrics are going to come back to the imbalance, and the demand will pick up again, and price will resume to a more palatable level.
So lithium has a lot of similar characteristics to the uranium market, and we are at the World Nuclear Symposium, and so we have to talk about uranium. But I'm curious to get your views on this. And Kevin, how many people at Traxys are responsible for trading uranium?
Sure. At Traxys, we have about a half a dozen people on the uranium desk spread around the world, covering clients from Asia to Europe to the Americas, some in sourcing markets where we originate supply from, and others in consumption markets where we sell to end users and customers. And we feel like that kind of coverage gives us unique perspective on the market and knowledge what's going on. We're able to interact with customers on a regular basis and have what we think is some of the best information in what's a very opaque market that allows us to drive our business forward successfully.
And maybe you can give us a sense of how important uranium is to Traxys overall in terms of revenues or in terms of pounds treated.
Sure. Traxys has always been a top 5 or 6 metal at Traxys over almost 20 years. Through the cycle, before Fukushima, even after Fukushima, very large, substantial business. And we do well north of 5 million pounds of business every year, sometimes double that, supplying utilities around the world. And our business is really, really geared around supplying our customers and helping them meet their fuel requirements. So, our balance sheet is set up to provide the capital to bridge the supply-demand gap between the producers when they want to produce and get paid, and consumers when they want to buy and pay for their material. And we have a balance sheet that's flexible and nimble, along with risk management and hedging tools, where we can offer a full suite of services to utilities to get them a tailored fuel supply that they need.
So why don't we dive into the spot market, and maybe you can provide us with some details on what's happening and where the price might be going. So as you know, the price is down 15% on the year. What's driving that price? Because I guess one of the things that surprises me is the fact that the backdrop for nuclear energy and uranium is so positive, but yet here we are down on the year.
Yeah, it's come off a little bit here, but I think we're optimistic. You know, I always you have to look at spot in the context of where the long-term price is, and the fact that the spot price got ahead of where the long-term price indicator is, I think was an indication it was a little bit frothy and overbought then. It's come back into balance now, and I think the long-term number now being higher than spot, around $80, low 80s now, will probably lead things higher going forward here. We expect more buying activity from utilities this fall. This conference is the kickoff of the fall buying season. We're expecting some RFPs and tenders from utilities, and I think you'll see resulting higher long-term pricing for uranium coming from that, and that will allow the spot price to move up as well. When those prices are in balance with each other, meaning there's a forward contango shape to that spot to long-term curve, the market's in a healthy position.
And can you speak to what's happening in the spot market right now? Is there a lot of sellers at a level like up at 85, or is there a lot of buyers down at 75?
Yeah, when we dipped into the 70s here in the last few weeks, a lot of buyers came out and showed a lot of demand there. There were a lot of utility buyers, traders, speculators. So it looks like there's a solid floor of support in the upper 70s there. We've bounced off it quite firmly here. So it feels like everything can go at least up from here. And the bottom has been put in.
And you mentioned RFPs earlier. Can you speak to that? How many are out there right now? And maybe you can also discuss the terms and size.
Yeah, we saw in August about a half a dozen RFPs come out from utilities, which is usually a quiet time when people are on the beach. But we nevertheless got about a half a dozen tender requests, which we offered into. I think that was indicative of the value that utilities are seeing at these price levels. As we've come down towards $80, utilities see value there and are essentially buying the dip. And I think that's going to provide the support going forward for higher prices in the rest of the year.
And does Traxys also deal in the term market and enrichment and conversion services also?
We do. We provide from uranium to conversion to enrichment to customers, and we can do that on a spot to a term basis. So we're really a very flexible supplier to our customers, and we specialize in the midterm time period, probably 2 to 3 years forward, and providing the different fuel components that customers need then. And so we can tailor a contract proposal to exactly what they need.
Kevin, earlier you mentioned that you've been coming to the World Nuclear Symposium for 25 consecutive years now. And so I want to hear how things have changed over those 25 years.
Sure, yes. It's been a long time. I can't believe 25 years that I've been coming to London the first week of September every year. But it's the place to be in the industry here. People come here globally from all corners of the earth, and so it's a great place to catch up with customers. Yeah, and over that time period, I've traded. I came in when the price was $5 a pound. I've seen it go up to $135 a pound, and almost back again. But I would say that qualifies as being through the cycle and seeing the market through the cycle. And I think what we have now. I think there's a lot of similarities with the 2006, 2007 price run-up in that we were in what allowed the price to go that high is we were in a production-driven supply dynamic then, meaning there was not inventory around to meet the demand that was coming to market. And I think we have a similar scenario now where there's demand is outstripping supply. There's a structural imbalance over the next several years. And so there's not an inventory pool for the next pound to come from. There's not a secondary supply for the next pound to come from. And so we need new mines, and then those next pounds have to come out of the ground from mines that aren't built or operating yet. And hence, I think that's why their price is as high as it is now and has more room to go. so production can catch up with that demand. And it's not the work of a moment to bring a mine online. Those are very long lead times, 5, 6, 7 years, depending on the jurisdiction. So it looks like there's a healthy several years ahead of us here. And supply tries to catch up with demand.
And because you were around during that last big cycle in 06, 07, what similarities do you see just in terms of the market, maybe in terms of the investor sentiment?
Yeah, back in 06 and 07, you would see uranium would be on CNBC, it would be on the front of the Wall Street Journal, and then after Fukushima, obviously got very quiet, but now that's all back again. So I think these are the hallmarks of a market and in business that's at the front of everybody's mind now, especially with the focus now on energy transition and net zero terms that hadn't been coined yet back in the last run-up, but we understand the concept and the clean benefits of nuclear and carbon-free generation. And so nuclear is having its moment now. It's sort of the nuclear renaissance 2.0, and it feels like we're picking up where we were and we're going forward. And what's unique this time is I think we have universal support across most governments. And in the U.S., both the Republicans and the Democrats are pro-nuclear now, because of energy transition, the electrification of transportation. So all of these thematics play into, a strong future for nuclear. And you overlay the new SMR ideas and plans that are coming to market, it looks like there's a pretty solid future here for nuclear.
So the other thing that didn't exist back in 06, 07, you didn't have China building out 150 nuclear reactors. And so I guess my question to you is, back then the price topped out at $136 a pound. Now it's at $80 a pound. Shouldn't the price of uranium be significantly higher than $80 a pound?
I think you have to look at where the forward supply-demand balance, you can see the structural shortage there. And what I always remind people with nuclear power versus maybe some other commodities, energy commodities, is you don't have a real-time consumption of uranium like you would with a natural gas plant or oil or coal, something like that, where there's a spark spread or something that can be tracked on the day, because it takes 2 to 3 years to build a fuel bundle, because the fuel is in the plant for 18 months, 24 months. Utilities don't always respond right away to price signals because they have some cushion and some runway built into their plans just based on the structure of the market. But ultimately, they do have to come to market, and we'll expect to see those buyers here before too long. You can see the gap in supply coming, and they're becoming more active to try to cover that.
So to that point, UxC recently came out with a study on utilities and what they've been acquiring in the last couple of years. And both U.S. utilities and also European utilities have been relatively quiet. They each acquired 2 million pounds, give or take. Whereas China, I believe it was 80 million pounds. And do you think there's a strategy here that the utilities are employing, that they're just waiting for the price to pull back and then they're going to get active again?
Yeah, that's a good question. There's probably some of them that don't want to put more heat on the market than they have to, and so they see prices high and are choosing to wait rather than cover and trying to pick their moment when they come to market here, which is fine. And listen, everybody has to get the best deal for their business and where they are in the fuel cycle. But ultimately, you can see that there's a structural shortage coming, and there's not enough to go around. So at some point, everybody's going to have to come to market. And so it's just a matter of when that demand crosses into the marketplace and how much supply is going to be there to meet it at that point in time. So I do see scope for higher prices here going forward. You mentioned China, especially with the growth in China. It's a dynamic that didn't exist the last time we had a big price run up. So it's certainly it's additional pressure on the market. So there's additional buyers out there that the more traditional utilities have to compete against now. So I think it's a solid future going forward for everybody in the business.
Well, Kevin, that was a great overview of what's happening in the uranium market. And I want to thank you very much for spending time with us today.
Thank you, Jimmy. Good to be with you today.
Ben, thank you very much for joining us today. You and your team at Jonh-Paul have done a lot of work on the geopolitical aspect of uranium. And when you look at the geopolitics, you got to be aware that Kazakhstan is the world's largest producer, controlling 45% of the world's production. Canada would be number 2, 20% of the world's production. And I kind of look at this and I want to compare it to OPEC, which is made up of 13 countries, and they control, I believe, 40% of the world's oil production. What are the ramifications for U.S. utilities or anyone else in the West for being reliant on uranium that comes from Kazakhstan?
Yeah, thanks for having me, Jimmy. It's great to meet you finally. I think that there's a variety of sort of ways that we can look at this. I think that ultimately, you know, Kazakhstan, as you mentioned, is almost a monopolistic producer in uranium. And I think that ultimately, you know, the US has built up a reliance not just on Kazakhstan, but also on the likes of Russia and Uzbekistan for quite a large chunk of their fuel supply. I think that also what that's, you know, allowed to happen, particularly in the US, is almost sort of, you know, the domestic industry in terms of the fuel cycle, both out the ground U3O8 enrichment and conversion, has pretty much stagnated over the last 30 years and is pretty much non-existent. I mean, in the US, for example, in the first quarter of this year, I think about 80,000 pounds was mined. That's on domestic requirements of about 40 million pounds, you know, alone just this year. So ultimately, you know, they really do need to look at how they can ramp that up. In terms of the geopolitical angle there, you know, I mean, we've sort of studied various aspects of this, from sort of the issues around transport out of Kazakhstan via the Trans-Caspian, but also understanding that, you know, in the last quarter, 75% of revenues of the state-owned or of Kazatomprom was from China. And this is at a time when China's just approved 11 new reactors. Another, you know, well-documented large customer of theirs is Russia. Only this morning did I see news that they're looking at approving 34 new reactors by 2042. So, you know, all of the sort of issues that they've spoken about around being able to ramp up production to 100% of their subsoil use agreements, I think that ultimately, you know, they came out and said that because they had sufficient confidence in their contract book to do so. So to me, that says if you're going to guide down 17% like they did a couple of weeks ago, that some utility somewhere is going to fall short. Whether that's going to be a Western utility or a Chinese or a Russian utility, I'm not sure. But there are some indications from which assets are sort of operating at full capacity versus those that are not, that perhaps the sort of Western-aligned JVs are operating slightly below those of Russians. But, you know, the company has come out and said that this is to do with the efficiency of acid and the acid constraints that they had, which is obviously, you know, quite difficult for us to work out. But I do think that generally, you know, the geopolitics, I think it's one of the most, you know, easily geopolitically weaponized commodities in the world because of how strategic it is to a lot of countries around the world. You know, again, in the US, 55% of their clean energy comes from nuclear power, and they just don't have a domestic fuel cycle to support that. So this reliance, and, you know, again, not just in Kazakhstan, but also in Russia, this dates back to the sort of early 90s. This was a program which was looking at downblending Russian weapons-grade uranium to fuel pretty much their entire US fleet. So something has to give, but, you know, one of the key themes from the conference has been how long these sort of processes take, how much capital is required, and that sort of chicken and egg problem where you need to have that commitment from capital markets and also from the public sector to go out and spend the billions of dollars to bring this sort of fuel cycle back home again.
Yeah, it's amazing. You mentioned that Kazatomprom cut their guidance by 17%. There wasn't really much of a reaction, and if there is, we really haven't seen it yet. But, you know, I think if OPEC came out tomorrow and said we're going to cut our oil production by 17%, it would probably be up 10 or 20% in a relatively short period of time. Or even the U.S., if they're the world's largest oil producer, producing 15 million barrels a day, if they were to come out and said they were going to cut their production by 17%, oil would catch a serious bid. But we really haven't seen that with uranium.
No, I think that's part to do with the fact that if we look back to sort of this time last year, I think it was September 2023, when Kazatomprom came out and said they were planning to return to 100% of subsoil by 2025. I think that the market at the time was sort of skeptical of that. And I think that from the various sort of the 2023 annual report, and then also the first half of this year, I think that it was to an extent priced in that the 31,000 tons was not going to come out of Kazakhstan next year. And that's probably what contributed at least somewhat to that rally that we saw when we were sat here this time last year at maybe $60 up to the sort of January high of 106. So I do think that there was an element of it that was priced in. We saw uranium prices move sort of $3 on the day. And I don't think that in the physical market it's necessarily had the reaction that we expected. One thing that I know surprised us and surprised physical traders and commentators on the space was the inventory number. The inventory number's now fallen below that 6 to 7 months of attributable production threshold that they need to keep in order to sort of maintain baseline inventories and also make sure that they have that sort of buffer for any contracts that they're unable to fulfill. That's now fallen below that threshold for the first time, I think, since 2016. So I think that's something that people will closely be monitoring. And also, this was really meant to be a restocking year for Kazatomprom. Again, you know, they came out and they said that the contract book, the long-term contracts that they had been speaking to utilities about, gave them the confidence they needed to ramp up. So, you know, back to this original point, someone is inevitably going to feel the brunt of that, and I guess we'll find out in the next years who that is.
We've had production cuts from both Kazatomprom and Cameco in the past year. We have ongoing supply deficits. We have massive demand coming from China and many other countries. So wouldn't logic dictate that the uranium price should be a lot higher than $80 a pound, like 100 or 125?
Mm-hmm.
So I guess my question to you is, why isn't the price significantly higher? We keep talking about this bullish story, and I think everybody would agree it is a very compelling story about why isn't the price higher?
Look, I think there's an element of we saw a very quick, fast move last year, and perhaps, you know, the market got slightly over its skis. I know that a lot of that ramp up sort of towards the end of last year was to do with trader activity as opposed to sort of fundamental sort of utility activity. I think also a contributor is the sort of lack of activity from the likes of Sprott. Again, if we were sat here 2 years ago, Sprott was sort of halfway through a £30 million procurement year, and that's obviously subdued slightly as a function, part to do with equity markets, but also, you know, the shares of the trust have not traded at a premium to NAV for a while. But on the supply side, the supply side story is so well told. The fragility of that supply side is so well told for all of the reasons that you mentioned, the largest suppliers in the world, seeing these sort of production cuts, you know, a large chunk of uranium that Europe specifically is reliant on, landlocked in Niger. It feels like this is, you know, I feel like the sort of next leg of this story is going to be what's going to happen to the demand side. And ultimately, that's what I think is going to drive prices much higher over the next few years. I think that, again, as is well documented, the data center story is something that's going to be a massive contributor to that. The number one threat, in my opinion, and in Oceanwall's opinion, to the AI sort of revolution, to the AI race, is power, is that you need so much more power to power these data centers than we currently have. You can go out and you're a hyperscaler like Microsoft and Google and say, I'm going to build 50 new data centers in the US, but you now have to come with your own power solutions to that. And they have to meet your ESG criteria. They have to be carbon, you know, renewable, carbon zero carbon power. You know, Google, for example, have pledged that by 2030. It's looking very, very unlikely that's going to happen. So to your point around pricing, I think that we need a sort of maybe increasing signals from the demand side that we're going to need a lot more nuclear power, and also perhaps a solution. We were just listening to a talk around financing and the length of time it takes to fund nuclear projects and how long it takes to build. The sort of 5 and 5 rule people used this morning, which was 5 years over budget and 5 times the cost. That's something that's, you know, perhaps, you know, can hinder the demand side because we can't start to roll out these reactors perhaps at the speed of which, you know, at least not to say it everywhere. In China, they're sort of walking the walk and they're building these things at a rate of knots that we've never seen before. We need to apply that sort of copy and paste production line economics, maybe perhaps the promise of something like SMRs to that, in order to see demand go from 190, 200 million pounds a day up to much higher levels. The deficit, though, remains a factor today regardless. So we expect to see much higher prices, both in spot and term. And although the uranium price in terms of spot has retraced slightly, you know, the term price, I think, is now 26 consecutive months of moving higher or staying the same. That's real utility demand. That's not the job of financial speculators or traders. This is what utilities are willing to pay for uranium. This, to me, every time the uranium price, every time the term price ticks up, it's indicative of further utility uncertainty around future supply.
So we can't have a discussion on geopolitics without discussing Russia.
Mm-hmm.
It's very important when it comes to both enrichment and conversion services.
Mm-hmm.
Maybe you can speak to that and also speak to the risk element to U.S. utilities and anyone else who's relying on Russia for these services.
Absolutely. Again, I mean, this goes back to the megatons to megawatts program that I mentioned in the early 90s. the US has built up this, this complete dependence pretty much on Russia, particularly in the conversion and enrichment space. And ultimately, you've got, your likes of Orano and Urenco here today talking about, they would love to look at expanding capacity and spend the billions of dollars that they need to expand enrichment capacity and conversion capacity. But you need to have clear signals from both the government and the utility that there's going to be a home for these pounds and for these kilograms of UF6 and EUP and fabrication. So I think, when you look at the geopolitics of uranium, there's an amazing book which I would urge all of your listeners to read by Marin Katusa called The Colder War. And there's an amazing chapter in that called The Putinization of Uranium. And it talks about this need of, if you've got a huge domestic stockpiles, you can have warehouses full of U3O8, but it's completely irrelevant in terms of servicing the 99% of nuclear reactors. So, there needs to be a push, particularly in places like the US who are so reliant on nuclear power, to bring this industry back to life, to bring the fuel cycle back to the US, because they used to do it. So it's not a technological problem, it's purely about policy. And obviously we saw a large step towards that with the Russian ban earlier this year, which has now started to give utilities that sort of clarity into the future, into the next 5, 10, 15 years of who and where they can contract. And so I think that's going to play a massive part. And I think that, as is well documented, term contract volumes are at quite low levels. But when you talk about conversion and enrichment, these things are up 500-600% in the last couple of years. The number one call that I got from clients of ours after Russia's invasion of Ukraine was, how do I get exposure to conversion and enrichment? And look, I know you guys, you look at the investing side of this, it's really difficult because this is pretty much dominated by state-owned enterprises. So, again, state-owned enterprises will work alongside the state, but they also need that sort of private sector incentive to get going. And ultimately, you need to have a clear indication that everything that you produce is going to have a home.
So, as you mentioned, both enrichment and conversion, they're both up significantly here in the last couple of years. Do you envision spot uranium making the same sort of move?
Yeah, I've always seen it as sort of that crystal ball. Eventually, you sort of have to trickle down, or eventually it will trickle down to spot uranium, U3O8. Again, people talk about, and I was having this conversation with someone yesterday, and I said, do you think that the US government will go out and continue this sort of purchase of EUP? And it was interesting that the US government sort of thought about it like, I'm going to go and buy some EUP without taking into consideration that you need to procure U3O8, UF6, and then you get your EUP. It's not a case of just going out there and buying your end enriched product towards the end. So yes, I really do think it's going to become a factor, because you have to go and there was a process by which you get to that enriched stage. So I think ultimately it has to trickle down to 308. I think we've seen that particularly over the last sort of 3 and 4 years, but it's nowhere near the levels that it should be. And I think that's going to ultimately be reflected in stuff like utility inventories, government inventories. And again, as a commentator on this space, it's really difficult to get. It's a very, very opaque market. China are not going to come out and release to you what the sort of strategic inventories are there. They have their Alashankou warehouse on the Chinese-Kazakh border, which has got a capacity of, can't remember what it is, 19,000 tons, massive sort of capacity. But getting an idea really on government inventories is quite difficult.
Yes, and that's another interesting point, is the fact that China is so far ahead of the curve compared to everybody else. They just didn't do it with uranium. They did that with battery metals too. That's why they dominate lithium-ion batteries in the whole EV space. And so it's interesting to see them do the same thing with uranium, building up these massive stockpiles. And I can only surmise in 10 years from now, the West is going to be standing there looking pretty.
To be clear on this, I mean, the work that we've done is that if China are to meet their nuclear ambitions, they're going to require about 1.2 billion pounds of uranium. If I take a sort of wide range of estimates that I've seen, between 500 to 600 million pounds they currently have stored in China. These guys are, the Chinese are not in sale mode. They're not looking to sell out this uranium at higher prices or to have sort of a cap in terms of pricing. Again, one of the first things that I learned in this sector is that the marginal cost of uranium for a nuclear power plant is sort of 5, 6, 7%. So fuel buyers will pay $50, they'll pay $500, because the sort of cost gets passed down to the consumer, ultimately results in much, much higher energy prices. One of the things that we saw that saw uranium prices fall from sort of 82 post the Kazatomprom guidance downgrade down to about $78 was a Chinese trader unloading sort of 400,000, 500,000 pounds of uranium. And it sort of spooked the market a bit, which is, are the Chinese going to sell in the exact same way we saw the Japanese sell post-Fukushima? And there's that sort of feeling of that scar tissue among people in the, but both in capital markets, but also utilities and fuel buyers and producers, that this was going to be the same thing again. Are China going to unload this sort of huge stockpile of uranium? Every piece of work that we've done indicates no, they're going to be net buyers of uranium over the next 10 to 15 years. And this really speaks to the sort of the size of that nuclear growth strategy. They really are doing it in a way that's completely different to what we've seen before.
So let's talk about the term market. So far this year, somewhere between 40 to 50 million pounds has been contracted versus 160 million pounds last year. When you walk the floors, are you hearing any chatter about potential contracts coming up before the year end?
Yeah, I mean, look, if it's ever going to happen, it's this week, right? This is when producers, uranium producers, fuel producers come and they meet with their respective utilities, and this is when documents get signed. I think that we'll definitely see a ramp up towards year end. Whether we meet that 160, I'm not sure. And I think that something needs to be made really clear here, which is that utility demand of nuclear fuel is completely discretionary. There is no sort of clock where if you say to me, Ben, when a price is going to go much higher, for how long are they going to stay there, and where are they going to go? It's so difficult to know that because it's so dependent around utility demand. And again, we have contracting seasons, which we're sort of entering now. But there's no sort of, there's no one forcing utilities to go out and contract at certain given prices. And again, as I just mentioned, they're not particularly price sensitive anyways. So, I think that we sort of end up in the remit of 120 to 140 million pounds contracted this year, which, as you mentioned, is going to leave us a pretty strong end to the year. We've seen, I think that, I can't remember what the exact number is, but, time prices are at $80. I don't know what the year-to-date performance is, but that's been on, as you mentioned, pretty small volume. If we saw another 80, 90 million pounds of contracting towards year-end, there's no doubt in my mind that the term price ends up above $90 towards year-end if we do see those kind of volumes. And I think that the spot market I think the spot price will probably follow suit.
Wow, so you're really bullish on the space if you're looking for that kind of demand going into year end.
I think so. I don't see any reason fundamentally why this sector should not have a massive few months.
I agree with you totally. Not just 3 months.
And beyond.
In the future, yeah. Now, what about the equities? We've seen a lot of the equities pull back given the movement in the spot price. How do you feel about the equities in here? Do you see good value?
When we were heading into the Kazakhstan guidance downgrade, we were sort of looking at the sector 30% off its highs pretty much across the board. So if we were going into that news off quite a high base, there would have been an element of, okay, is this priced in? It definitely doesn't feel like it at all, especially, I think that the one thing that's been completely, the sector has not had cash flows for so long. There was sort of 12-year uranium bear market where the sector was completely bereft of cash flows. What we're starting to see now in the various restarts is meaningful cash flows returning to the sector. And ultimately, there's sort of this snowball effect of you've got higher spot term prices. This incentivizes production to an extent, although the supply side response has been sort of subdued. I think more than any other commodity. But yeah, I think that ultimately term prices, spot prices towards year end going to be much higher, and that's going to have this sort of downstream impact on equities. We can still see equities are pretty pegged to what's happening in the underlying commodity price. In terms of where to allocate, having an allocation to physical, I think is always a good idea, especially with some of those with some of the uranium trusts like Yellowcake and Sprott, it's sort of double digit discounts to their net asset values. But then you've kind of got the sort of the higher torque upside equity cases. I think investing in North American jurisdiction uranium mines with good quality assets, quality management teams is going to serve people really, really well.
Then as we wrap up, what is your message to investors who might be concerned with this recent pullback that we've seen in the uranium price?
I think that for people coming to it fresh, I would just say that this is the volatility of the sector. I was looking back at sort of previous pullbacks in this, particularly in the equity market. There's been 8 double-digit pullbacks since I started covering the sector 4 years ago. I've sort of put this down to another one of those, but we're coming off a much, much higher base today than we have before. Again, people like to use the 2007 sort of example. This is what happened then. This is what can happen now. Half the world hated nuclear power in 2007. We have bipartisan support in the Senate for nuclear power. We are seeing restarts, recommissionings. We're seeing nascent nuclear power strategies across Europe, the US, and Asia. We are seeing the most, traditionally anti-nuclear governments in the world completely U-turning on their nuclear strategies. There has never been a better time to invest in the nuclear sector, and the supply-demand fundamentals of uranium specifically. I don't think you can find a better story in commodity markets than you have in uranium.
Always good to finish on a strong note. Once again, Ben, thank you.
Thanks, Jimmy.
Jonh-Paul, thank you very much for joining us today. According to the World Nuclear Association, Urenco is the second largest enricher in the world, having just over 30% market share. So you have a very unique perspective on what's happening in this part of the fuel cycle. And enrichment prices have been making all-time highs. And I want to get your thoughts on why this is and if you think this trend will continue into the future.
Well, first of all, let's just tackle the concept of, are we at an all-time high? Because I think in real terms, the prices in our industry for enrichment pre-Fukushima were quite a bit higher than they are today. It kind of does feel like that, though. It kind of feels like we're at all-time highs because it wasn't too long ago that prices were at their lowest. They're about $38 on the spot market, $38 per kg, which were just not sustainable prices in our line of work. That's where our industries lay off people, write down assets, and look for strategies to sort of bring back capacity and downsize, right size for the market. So it feels like we're at all-time highs. We're now at term prices about $165, so that's a huge jump from where we saw it. But actually that's more in response to what's going on geopolitically. So in particular, the Russian invasion of Ukraine. And so now we're seeing prices that sort of match what it would take for investments to be made in the sort of Western fuel cycle. So that's the short-term view of it. And longer-term, prices in that region would continue to sustain those investment decisions. But there's also, you've also got to think about the fuel cycle as a whole. So the enrichment price, there is a strong link there between the other components in the fuel cycle. So you've got to look at the uranium market, you've got to look at the conversion market, because nuclear fuel at the end of the day is a complete product, complete fabricated product. Enrichment is just one aspect to get you there.
And Jonh-Paul, do you have plans on adding capacity in your U.S. facilities or any other facility?
Yep, so where the prices are right now, they are supportive of investment decisions. And so we have taken decisions to make some investments. So initially we're looking at 1.8 million SWU to strengthen our capacity, and that's going to be at a number of our facilities. So we've got many options at different sites. In particular, the US, Germany and the Netherlands is where we're going to focus for LEU investment decisions at the moment.
And can you put that number into perspective for us, 1.8 million SWU? What is your total SWU capacity at Urenco?
Total SWU capacity at Urenco at the moment is 17.6 million SWU. So yeah, you're looking at a 10% equivalent. It's also approximately about, you could compare that to the US market. The US market's about 15 million SWU. So a little over 10% equivalent of that market too, just for comparison's sake.
And in order to add this additional capacity, you want to do so once you have contracts lined up, because you don't want to be spending billions of dollars on CapEx and not have the contracts to pay for it. But how is that process going?
Yeah, so absolutely. It's very important to us to underpin these investments with contracts, and just how the market works. And don't forget, it takes a while to get these investments off the ground. It takes a few years to sort of design these things, build these things, bring them online, and then they're operating for a series of years after. So you don't make these to respond to short-term economic trends. You have to do that on the back of long-term stability, and long-term contracts is the absolute best way to do that. So we've made that decision, we've made a decision to expand, and that has come from success in the market and securing some long-term contracts. But for the global ambition and what we see in the US, they want more capacity, domestically. We'll need to continue down that path.
I want to talk about Russia now. How does the U.S. ban on Russian imports impact Urenco?
So I guess the ban itself, very specifically to the US, first of all, and it's really, as it says in the legislation, it's to help the US reduce and eliminate its dependency on Russian nuclear fuel services and nuclear fuel. So in the short term, there is Russian imports into the US, and even perhaps before the legislation hit, we saw utilities reduce their exposure. You can see that in the public domain through their financial statements. A lot of concern in the market. The US utilities made moves to hedge their positions and reduce their exposure to Russian supplies. So in the short term, there was some movement. Actually, there are waivers to this process, so there hasn't been any huge disruptions. There is still some imports coming in. So there is not a huge amount of impact going on in the short term. I think longer term is where it makes a much bigger difference. It definitely creates that certainty that helps companies like ourselves look at our investment portfolios. What are we going to do? Where are we going to invest our money? Should we grow? Should we help with the challenge that the US faces? And that does help. But it is a global issue. So the fact the US have legislation doesn't necessarily mean the world will follow suit. So you've got to ask yourselves, and companies like us ask ourselves, well, will that just move the problem somewhere else? Will there be a movement of material, maybe more competition in Europe or elsewhere in the world? So absolutely makes a huge difference, but you have to think about this globally as well.
The U.S. Department of Energy has issued a $3.4 billion RFP. Is Urenco planning on submitting a proposal for this?
Short answer, yes. Absolutely, we support what they're trying to do there. So invest in domestic enrichment capacity, moving the US away from being a net importer, and in light of their sort of legislation, help them to reduce and eliminate dependence on Russian material. We will be responding to that. We are also conscious, I think everybody should be conscious about how that could impact the market, and hopefully in the right way and not necessarily in a disruptive way. So if it's a pure subsidy, for instance, that could cause some repercussions, some other uncertainty. But as it stands, we're responding and we're supportive.
I want to touch on overfeeding now. Is Urenco transitioning to overfeeding? And if so, how is this impacting future EUP production?
So let's tackle the overfeeding concept first, because I often hear people talk about underfeeding, overfeeding, and what does it really mean? It's actually a very relative concept. It's relative to what you're already doing. So overfeeding is a situation where, at our own expense, an enricher would go and acquire more uranium, run that through the plants, and use more uranium than the customer gives them to produce fuel. The benefit of that is we produce more fuel. Underfeeding, the concept there is the opposite. So we get fuel from the customer, and at our own expense of the time and the energy costs, we use less of that and we produce the fuel, but we manage to preserve some uranium in the process. It's relative because it's all about how much fuel you're given in the first place, how much uranium you're given in the first place to use. So let me use an analogy. Driving a car, right? I think most people drive a car. If I said, let's drive from point A to point B at 70 miles an hour, you were to give me the fuel, okay, you're going to drive 70 miles an hour, I'm going to fill your tank up to make sure you get from point A to point B exactly on time, and by the time you get there, your tank will be empty. Right? Similar thing. Overfeeding would be, just going to ignore that, I'm going to drive 120 miles an hour, I'm going to go much faster, I'm going to get there much quicker, but in the process, as with most things, if you're going to drive fast, your fuel efficiency goes down, so we'll be using more fuel than you'll put in the tank. That's the concept here. So overfeeding, underfeeding is relative, but what does it really mean for Urenco? We have to move our operations constantly, so we're constantly changing the speed of the car and how much fuel we're using to deliver EUP to customers. In the near term, we can't change the efficiency of the car, we can't build more cars, we just have to adjust the speed, right? And so that's how we respond. I wouldn't even necessarily be overfeeding, underfeeding into it. We would just, as you described, the throughput of uranium will increase and decrease. The more it increases, the more fuel we can create. And that's exactly what's happened in recent times. We've been on a sort of cost-saving footing. We've been looking at writing down our assets. Completely wrong mindset, and suddenly, effectively a supply disruption. Can you fulfill a gap in the market where perhaps Russia had supplied material? So we've got to change operations. So the throughput increases. We need more uranium, we need more conversion. Physically, it needs to come to the plant, and as a result, we can create more fuel. Long answer to your question, but that's what we're doing all the time. So technically, is it overfeeding, underfeeding? It's really down to whether we've gone out ourselves to buy that uranium or whether it's arrived. But we certainly are increasing the throughput of uranium to our sites and plan to meet customers' demand and help with security of supply issues.
I like that analogy. Even I can understand that. So let's talk about conversion now. And there's concern that conversion is a bottleneck that will impact EUP production. What are your thoughts on this?
Yeah, so like I was saying, to increase the amount of fuel we can produce, the throughput of uranium and conversion needs to follow suit. So we need physically the uranium in the form of UF6 to turn up to our sites to be able to produce more fuel. Conversion is the middle step between it coming out of the ground and it being usable for enrichment sites. So absolutely, we are relying on conversion services to be there and also work with us in looking to make investment decisions and capacity expansion, especially if demand increases. Nuclear fuel is required, and that comes about through more plants being built, perhaps advanced plants, AMRs, SMRs, that kind of thing. So the way we see it, conversion could be a bottleneck. There's very little investment that's gone into conversion plants in the past few decades. They've been really up against it, and they kind of look at the market in the same way we do in terms of like the demand side, how much conversion is needed. They also look at the enrichers and think, well, how much, if we change operations, it impacts down the sort of downstream or upstream capacity decisions too. But at the moment there are a few projects underway, a few investment decisions we see out there. In particular, there's no repu conversion in the Western sphere of influence, so that's something that needs to be addressed. And we see potentially capacity additions elsewhere in the market, but I think you'd need to see something.
Jonh-Paul, Urenco in conjunction with the British government is constructing a HALEU plant. Maybe you can provide a brief update on this plant and where it stands.
So yeah, it's been fantastic news that we've managed to partner with UK government. This means we can build a HALEU facility by the early 2030s. And that addresses an issue with perhaps a new and very exciting market. So the HALEU market is really addressing the fuel requirements for the next generation reactor, the advanced reactor, the reactors that are inherently safe. And these are the sorts of things that we hope you'll put next to data centers and really start to make inroads into the green energy issue, the energy transition, to help tackle climate change. They also tackle security of supply and a whole number of other issues. So the plant there, with the help of the UK government, helps us make that decision, invest that money, design and build that in the UK so that we can provide the fuel. The market currently doesn't exist. The vendors, the guys that want to build these reactors have the same issues. They're trying to get their licenses approved. They're trying to get investments to build their own advanced reactors and prove these concepts. There's a whole program in the US, demonstration, advanced reactor demonstration program. And by investing in a HALEU plant, we can support those guys. We can produce the fuel for the future reactors, and that should enable us to get that market up and running.
Jonh-Paul, I want to thank you very much for spending time with us today and sharing your views on the enrichment segment of the fuel cycle.
Thank you. It's been a pleasure.
Jonathan, thank you for joining us today. UxC offers many different services to the nuclear energy and the uranium industries, the most important of which is price analysis and forecasting. And I'm sure you would agree with me when I say the long-term fundamentals for both nuclear energy and by extension uranium is very bullish, but yet we're not really seeing the price movement that you would expect given this scenario. And when you look at the spot price, it's down 15% on the year. In terms of contracting, we're at somewhere between 40 to 50 million pounds on the year versus 160 million pounds last year. Why the lack of interest this year, especially given such a positive backdrop?
Well, Jimmy, thanks for having me again. It's good to see you here in London. You're right. I mean, this conference is an example of the bullishness in this market. I mean, it's sold out crowd. They have to turn people away. So clearly there's a lot of interest in this market. There's a lot of growth. Obviously, not just growth currently, but the outlook for more growth is pretty strong. But, you know, the uranium market, it's a bit of a quirky thing. It doesn't always follow a straight path, just like most commodity markets. Sometimes, you know, these longer-term fundamentals take a little bit of time to materialize in the actual data points. But you have to appreciate, so yes, we're around an $80 spot market right now, which is down from, you know, above 100 early this year. However, I like to point out the fact that this time last year we were around a $55 market. So we are actually up quite a bit in a pretty short period of time. So it's not like the spot market is lagging in a big way. It's just that, you know, we had some early last year, late last year, and early this year, we had some, I don't want to say overzealousness in the market, but, you know, that maybe the move up to above 100 wasn't really reflective of the fundamentals at that time. You know, we had some factors in the market that we weren't sure about, things like will Russian material be fully banned out of the U.S., you know, the Niger situation, will uranium come out of there or not? Will Kazakhstan have issues production? You know, a host of questions. Some of those questions have been answered, or at least in the near term. You know, Russian material is still flowing. So, you know, in some cases that has affected the spot market. But look, you're absolutely right. The fundamentals are really solid. We just had, you know, Chinese approvals for a lot more reactors. We've seen, you know, demand pushing forward when it comes to AI and data centered, you know, for nuclear energy. So I think all of that is percolating, and it's going to continue to be a positive trend. And then, you know, the other thing, when I look at the spot market where we are, we have fallen back, but we're not falling much more. It feels like the high 70s is like a floor in the market right now. And every time you see maybe an offer that's below 80, there's a bid right behind that trying to pick that material up. So people think that that's a good price. The other factor I'd mention is that while on the term market, it's been a down year so far, we have, now that the prices come back, we have seen a lot more utilities show interest. So from that standpoint, a bit of a correction in the spot market actually is a positive, because it allows the utilities to enter the market in a way that they may not have at $100. So I think that demand for the term market and the contract market for utilities could look very positive going into the fall.
So let's spend a little more time on what the utilities are doing. UxC recently came out with a report titled The Global Nuclear Fuel Inventories. Take us through that report and what your findings were.
Yeah, so look, this is a market where there's a big lead time for supply. So uranium is just the first step in the cycle, right? So utilities need all forms of nuclear fuel to get to the final fuel assembly that goes in the reactor. So there's always a lot of inventory in the system. Up to 3 years worth of material can be sort of in process. So that's work in progress material, not necessarily what we call strategic inventories. But in the last couple of years, you've seen utilities, specific utilities in the U.S. and Europe, respond to some of the security of supply concerns and actually do a little bit of extra buying on top of what they needed. So we have seen a little uptick in inventories, nothing dramatic. And then, of course, China, because of all the outlook for growth there, has continued to accumulate more material. So, that has been really positive on the demand side. The inventory buying is a positive. And the difference between a period like in, the mid-2010s when it was just oversupply and we didn't know what to do with the material that was being produced. So the inventory growth in the last couple of years hasn't been dramatic. It's been less than 10% over the 2-year period in places like the U.S. and Europe. But I think that is reflective of concerns by utilities about future supply, and it's not material that they necessarily will be putting back in the market, so to speak, or using to cover needs without buying more. In fact, I think that the era of higher strategic inventory holdings is now upon us. Utilities will not go to bare bones inventories. In some cases, we're even seeing utilities that typically haven't held a lot of inventories go to holding inventories, which I think is a sign of, not just concern over current supply situation, but the outlook for future supply. And so, that is demand on top of the consumption for fuel in the reactors. So all of that is, I think, additive on the demand side, and it should over time, lead to more growth in, contract activity and interest. And I don't think people are seeing the inventory situation as any kind of overhang right now. There's always questions about certain pockets of material that could come into the market, but that's not, there's no concern at the moment that we have a lot of uranium sitting on the sidelines, not finding a hole.
So let's quantify your findings. You mentioned that the Chinese have been very aggressive in the last 2 years. How many pounds have they acquired versus, and how does that compare to the Americans or the Europeans?
Yeah, so it's tricky. The Chinese are a major buyer, as you know. They have been for the last decade. And they entered the market in 2010, really, for the first time in a big way. And for every year since then, have imported on average somewhere in the neighborhood of 60 million pounds a year, whereas their consumption is currently still only around 30 to 35 million pounds a year. So they buy a lot more than they actually consume. That said, China is very long-term focused. And so, that extra buying that they do is driven by government policy. And they really want to ensure that they will never have a shortfall of uranium, whether it be the next year or 10 years from now. And, it probably is appreciated already in the market, but the fact is China its biggest Achilles heel is natural uranium. They don't have a lot of it in country. This is why they've pushed so hard to access uranium in Namibia, obviously joint ventures in Kazakhstan, and we're aware of them pushing hard and looking for other places for access to resources, on top, of course, of contracting with a lot of the major players in the market. So, China compares to U.S. or Europe in a way that it's the only country I could see somewhat similar is Japan, which over the years has also been a very heavy on inventory holding kind of country. Even pre-Fukushima, Japan, the utilities held much more uranium than they actually needed. And this is because, when you're a country that doesn't have a lot of their own natural resources, you tend to be concerned over the potential for, shipping issues or access to that material. So, look, the U.S. and Europe, they tend to be somewhere in the neighborhood of 24 to 36 month forward coverage on inventories, whereas, the Chinese, the Japanese are somewhere in the neighborhood of 6 to 7 years forward coverage. So pretty significant difference.
So if the Chinese are acquiring 60 million pounds a year, what about the Americans? How many would they acquire on average? And what about the Europeans?
Yeah, so the U.S. is somewhere in the neighborhood of 45 to 50 million pounds a year. Europeans have been higher than that, but now with shutdowns in Germany and the like, it's probably closer to around 40 to 45 million pounds a year. So, all those three markets are very big, very important individually, and combined, of course, represent the vast majority of the global market. Those are the key places to look for when you're talking about where the next source of demand is going to come from, whether it be contracting or even spot.
So in the last 2 years, both the Americans and the Europeans have been relatively quiet compared to the Chinese. But what do you think their strategy is here? Or did they think the price went too high and therefore they're just kind of standing back, hoping the price is going to come in?
Yeah, I'd correct you slightly that the Europeans probably have been a little more proactive, in my view, mainly because, the Ukraine situation is right on their doorstep and they see that potential for cutoff from Russia or other reasons, transport out of Kazakhstan, whatever. So they have been a little more active, the Europeans, but certainly they still are uncovered needs in Europe in the next 5 years. U.S. have been very slow to be covering their needs. If you look at the U.S. Energy Information Administration data, there's sizable quantities of uncovered demand, out in the late 2020s still. What drives their thinking? I mean, look, I can't speak for every U.S. utility buyer, but I think that, yes, the price rising rapidly was a kind of, the response to that tends to be, we're going to wait and see. They get a little freezing kind of motion and then just don't want to be part of a fast upward moving market. They think maybe that they would be contributing to even further increases in price. As I said before, a little bit of a correction in the market has now created that opening for utilities to re-enter the market. There's also been, of course, a lot of questions around policy, trade policy with, the Russia ban in the U.S. That probably also contributed to things.
Okay, let's talk about the spot market now. Give us a sense of what's happening in the spot market. You mentioned earlier that you think $80 is a good floor. How many buyers are in the spot market and what sort of quantity are they looking for? And then give us a sense of what's happening on the sell side.
Yeah, so, look, the spot market continues to be quite active. We did have a quiet summer for a little bit, but even by the middle of August, we saw a lot more activity. As I mentioned, utility demand, even for some near term, like 2025, 2026 demand came in with the spot price being a little lower and with the interest rates coming down a little bit. You've got the opportunity now for intermediaries, traders, and the like to do carry trades again. And so that brings demand forward into the spot market, which is a positive. And then when you look at the kind of buying that's going on, for a long time, there was a lot more demand coming from the financial community. not a secret that the Sprott vehicle hasn't been able to raise that much money in the last couple of months, so that obviously hasn't been a major factor in the market. So it's been probably more intermediary kind of demand that's been the driver recently. But you've got utilities, as I said, you've got some producer buying, you've got still some financials out there, maybe some hedge funds and the like. And on the supply side, it's not a heavily supplied market. In any given day, you might be able to get 300,000, 400,000, 500,000 pounds. But if you went out and tried to buy 1 million pounds right now, you wouldn't necessarily not find it, but you would be moving the market, a couple bucks at least, if not more. So there's not a lot. As I said, people are not bidding 1 million pounds right now. Most bids are for smaller pockets of material, but if you wanted to locate more material, it would definitely move the market, and that's a sign that the supply is, I wouldn't say super tight, but it's still not a heavily it's not a super liquid situation either right now.
And what about the term market? We mentioned earlier, it's been relatively quiet, only 40 to 50 million pounds so far this year versus 160 last year. Do you expect to see a pickup in contracting as we go into year end?
Yes, I do. I mean, it's not unusual that the fall months tend to be more active. People use often this conference as a sort of starting gun for that process. Utility buyers coming to meet with producers and suppliers to gauge what kind of supplies out there, what kind of contract terms and conditions are available. I think that there is still a lot of need for delivery of contracting material for the next 4 or 5 years, but then it really opens up post 2030. And, in some cases, some producers, existing ones, don't exactly have a lot available between now and 2030. So you're having to find, utilities that need to cover in the next 4 or 5 years are having to mix and match their supply. They can't just go to one guy and get it all from one individual producer. I think the fact is that utilities that have needs between now and 2030 will have to get more active. Otherwise, they'll be potentially finding that they can't get what they need, at least not at the right time. And that's going to be, I think there is a bit of a pinch coming for the next, for the medium term. And then if you look past 2030, it's all about where's the new production going to come from. You've already seen some announcements from a number of mainly restarting mines underpinning those with restarts with new contracts recently. But if you look post 2030, it's greenfield projects. It's mines that actually have never produced before that need to be built, and the utility role in supporting that is important, is critical. And I think we're going to see more and more utility interest in growing the supply side post 2030. I can't say that it's going to be in the next 6 months that we're going to see a lot of contracting for that, but I do think that over the next 2-3 years, that's going to be the focus point for a lot of utilities. It's not just covering in the medium term, but post 2030. So you've already seen a lot of contracting post 2030 for enrichment and conversion. And typically what happens is uranium comes after that. Utilities start with enrichment and work backwards. So, I think that's another factor that's going to mean that utilities now focus more on the uranium space. They just haven't had this, the bandwidth to do enrichment, conversion, uranium all at the same time. So I do think that the uranium is the current, focal point of a lot of utilities.
So when we spoke this time last year and we were talking about enrichment and conversion, you said conversion was the tightest part of the fuel cycle. Is that still the case?
Yeah, I mean, look, since then, very little has changed in conversion other than prices are higher again. We don't have any new supply yet announced in conversion. The only thing that we can point to is that the Metropolis plant in the U.S. is now functioning pretty well and is producing every last kgu of UF6 that they're producing is being used up pretty quickly. But yeah, definitely the conversion space is still super tight. We're at a $68 spot market for conversion, which, if you had told me we would ever get to $68, I wouldn't have believed you. Now I do. Since I published the price, I think I know that. But yeah, it's crazy what's going on in conversion, and I don't see a real quick, correction there. I think it's going to take some time. That said, the pinch isn't just conversion anymore. I do think when you look at 2030, we don't know yet where all the uranium that's going to be needed is going to come from. So uranium will evolve into a pinch pretty soon if the right moves aren't taken sooner than later.
And given that we're seeing all-time highs in both conversion and enrichment services, can we assume that uranium is relatively cheap in comparison to those products?
I do think so. I think, $80 isn't reflective of necessarily the incentive price that's needed for post-2030 production. And so I do think that we could see a move upwards still. It's hard to always predict where the market's going to go in terms of pricing, but, the fact that we were at 100 plus just earlier this year, is that repeatable? It certainly is. We did have a $136 price back in 2007, but that lasted for like a week. So, you don't always, markets can shoot up pretty quickly, but don't always hold there. So I think what you're looking at now, especially like with the term price being at 80 and continuing to move up more gradually, that's more of a step progression that is a healthy kind of move in a market, because that sort of sets the floor again for the, and usually we see utilities react more to that price. If the spot price is moving too quick, they might hold back, as I said. So yeah, I think you're going to necessarily see, spot pricing continue to have an upward trend. I just don't know how quick that's going to move. And, is $80 cheap? Compared to where we were just a few years ago, it might look pretty expensive, but compared to what the outlook is for supply and demand and the fundamentals, yeah, you could say 80 isn't a bad price right now at all.
And you've been involved in UxC for over 20 years now. Have you ever experienced a more positive backdrop than we are witnessing right now with the nuclear energy and also the uranium sector?
It definitely is, it's the most positive, or at least close to it. We did have a kind of a nuclear renaissance back in the mid-2000s, but that was, maybe not driven by the same kind of strong underpinning on energy demand growth. What we're seeing now with not just AI and data centers, but, EVs and, everything is moving to looking for clean energy, stable supplies of energy. So, yeah, I mean, that is super positive in my view. And we've got an outlook here that, by 2040, we could see nuclear grow in a dramatic way. And I'm starting to see it myself in, whether it's the small and advanced reactor world, whether it's new countries looking at nuclear power, whether it's some of the major countries that we just talked about, China, U.S., parts of Europe, Japan, get back into it in a way that maybe just a few years ago they weren't. The fact we're starting to talk about restarting reactors in the U.S. that were shut down, I mean, that was not even on the radar at this time last year. So definitely super positive, and it's a great time to be in nuclear.
Jonathan, that was a great overview of what's happening in the spot and term market, and I want to thank you very much for sharing your thoughts with us today.
Well, thanks for having me, Jimmy. It's a pleasure.
Dastan, thank you very much for joining us today. We have a lot to discuss in a short period of time, so why don't we just begin with the latest news that came out from Kazatomprom, a 17% cut in 2025 production numbers.
Hi, James. Thank you. Whilst it was a cut, it was still a 12% raise compared to 2024. I don't think it's a news to the market on all these production constraints that we've experienced in our region, and acid is the key driver behind all these production cuts. But I think we've tried to be really transparent all along the way in order to notify everyone, let people know on what's actually happening.
Is Kazatomprom in a position to fulfill its 2025 sales commitments?
Absolutely. We're utterly confident that we'll be able to deliver all our commitments. People actually expect us to go into the spot market, and this has been happening for quite a while now, but I'm afraid we hate to disappoint all these people, because should we actually go to the spot market in order to cover up for our own needs, of course, there's going to be a huge hysteria on the market, and I expect prices to go up. So that's why there is a lot of interested parties that are willing for us to do so, basically.
Dastan, let's talk about inventory levels now, because this is another potential issue. And a lot of people are concerned that there was only 4,000 tons of inventory. Can you speak to this?
Yeah, sure. People take note of that, because previously our inventory levels were a bit higher, but people tend to forget that even the current figure represents 7% of the world's primary production. And we're utterly confident as well that this level of inventory will enable us to fulfill all our commitments and obligations. Of course, if we have an opportunity to replenish our inventory levels, we'll do so.
And 4,000 tons would last for how many months?
Well, it's difficult to say based on the stretches that may happen with the delivery schedules, but these levels are sufficient enough.
And what do you typically keep on hand?
We don't have an exact figure, but historically that was 6 to 8 months of attributable production.
So you mentioned earlier that one of the big issues was sulfuric acid. You currently have 2 plants producing it. You're constructing a 3rd plant. When will that 3rd plant come online, and what will be the annual production coming out of that plant?
We expect the 3rd plant to come online in 2027. It's a bit adjusted. There are certain delays, because previously we said that it come online in 2026, but that was towards the end of the year. So this shift into the next year is not significant. It's not going to affect the operations very hard. And also the capacity is at 800,000 tons. So along with the 2 existing ones, we will have 1,500 tons of sulfuric acid supply.
Okay, let's talk about reserves and resources. Very important element of any mining company is replacing the reserves. And the only way you can do that is by exploration. Maybe you can speak to your exploration strategy.
Yes, thank you. That is an excellent question. And I think that is a very important issue going on forward. We are on the company level right now are designing a new geological exploration plan, if so it could be said, and giving and allocating, dedicating a lot of our efforts in order to replenish our resource base and invest further into geological exploration. In Kazakhstan, I think our unique geology enables us to invest greatly into this endeavor, because the returns on that will be very significant. So the company itself right now is concentrating a lot with regards to geological exploration and replenishment of our existing resource base. This is a top priority for the company, and given the approaching uranium deficit and the supply and demand fundamentals, this is the right move to make.
The other thing I want to ask about is the mineral extraction tax that was imposed by the country of Kazakhstan. It's going from 6% to 9% starting on January the 1st of 2025. What does this mean for your business, and what does it mean for buyers or utilities?
This new introduction of this tax is going to affect our cost of production. It's going to be reflected in that. But also, we've prepared a special table based on the production levels, and it's available on our website. So one can just go and see the actual impact based on the production levels. Whereas the rationale behind the introduction of such a tax is driven by the government's willingness to align the taxes on uranium, because historically uranium industry operated under a very favorable tax conditions compared to other extracting industries in Kazakhstan, whereas we have the oil industry where they have the excessive profit tax and other royalties imposed on them So the government, seeing this new nuclear renaissance, decided that it would only be fair in order to align the tax regimes on uranium, oil, and other sectors of the economy. So in certain sense, this new introduction was anything but inevitable.
So let's talk about the long-term contracting market. We're currently somewhere between 40 to 50 million pounds have been contracted this year versus 160 million pounds in 2023. Maybe you can give me your views on why it's been so quiet this year and where you think it might go as we go into year-end.
Yeah, as you well know yourself, there is a certain degree of seasonality with regards to concluding contracts and market activity in the summer. Compared to other periods, was always a bit can be attributed with lower marketing activity in general. Also, current WNA Symposium, I think we're going to see a lot more contracting happening after this symposium, so next week. And also one huge factor that needs to be taken into account is the upcoming US elections. So we expect contracting activity to increase towards the end of the year.
So we can expect some positive news releases coming from Kazatomprom as we go into year-end regarding contracting?
Hopefully.
Dastan, as we wrap up, we are in one of the greatest cities in the world, London. What do you love most about coming to London?
I could actually talk non-stop about London. I think that it's best to describe this with a quote of famous 18th century writer Samuel Johnson, who said that if a man is tired of London, he is tired of life, for London has everything that life can afford.
That's a great quote. Well, once again, thank you.
Thank you, James. Always a pleasure.